It is Friday, March 10th here in New York City. I'm Julie Hyman alongside Inez Ferre in for Brad Smith. This is Yahoo Finance Live. Happy Jobs Day. We take a look at futures here as we await the jobs numbers, and we are looking at a downdraft in futures. The jobs expectations here, let's run through them quickly. Non-farm payrolls estimated to have risen 225,000. Now recall, last month we had a blowout upside surprise of 517,000 jobs added to the U.S. economy. So the big question is, will we see some of that momentum continue? 3.4% the unemployment rate, average hourly wages up 4.7% year over year, 0.3% month over month. We will be watching all of that very, very closely. And of course, also to see what the balance in where jobs are added, what that looks like. We, of course, have seen a lot of additions continue in hospitality and leisure, as we have seen spending go in that direction. And we also have heard anecdotally about a lot of cuts in the tech sector, Inez. What are you watching here as we go into the report?
Yeah, I'm definitely going to be watching the different sectors. This is going to be an interesting report because it's going to be very crucial as far as the data that the Fed is looking at as to whether or not to bump rates by 25 basis points or 50 basis points. So if this comes in hotter than expected, could there be a 50 basis point rate hike in March? But look, I'm taking a look at if you are bullish about this, if you think that this will come in hotter than expected, then you probably are looking at job openings. We had the JOLTS report recently that showed the openings. Now, JOLTS showing openings declined by less than expected in January, but still and at elevated levels. I mean, you are looking at these levels that are highly elevated, and you're also taking a look at the ratio of job openings versus unemployed ratio. And this is something that Jerome Powell pointed out during his testimony this week as well. It's at 1.9 jobs per person. It was at 1.9 jobs per person in January. So if this continues to be elevated, then we are still in a very tight labor market. That means that the Fed will have to continue to tighten. Yeah, and kind of drilling down a little bit, I'm watching construction jobs in particular. Our Jared Blickery wrote an interesting piece that's up on the Yahoo Finance platform that talks about how construction jobs lagging can sometimes lead the rest of the economy. Construction job openings actually fell. And then Thomas Kennedy of JP Morgan, who we spoke to yesterday, and as you recall, he made a really interesting point. He said, if you look at housing starts versus housing completions, and here is the chart of that. Housing completions, the purple line, starts, the blue line. Completions are still relatively high. Starts are starting to come down, which indicates that, you know, the people who just worked on a finished job, maybe not all of them are going to get hired for the next construction job that's happening. So that is something that I'm watching. And an interesting note that he made when he talked about looking for some cracks in the U.S. economy, that was one of the places he was looking. Of course, a lot of economists already think that we are in what they call a housing recession, as we are seeing a pullback in demand for housing. But all of that playing into what we're going to hear today. Yeah, and it really starts with housing, and then it goes through construction jobs, and then it goes into durable goods because you need to put things in those houses. Sure. So manufacturing then gets hit. That's sort of the ripple effect. That is sort of the trend of how all of this starts. We have seen layoffs in the tech industry so far. We've seen layoffs in other industries as well. I mean, you have had the banking sector as well doing some layoffs, but we are, as you mentioned, watching that construction like a hawk. Yeah, we are. And just to take a step back here as we look at today's report and why there's always a lot of attention on jobs report. Why is there so much attention on this jobs report in particular? Of course, it has to do with the Federal Reserve here. Because we had that hot number in January, because we then have had other subsequent data points that have shown that maybe inflation didn't come down as much as the rate of inflation didn't come down as much as economists had estimated. Then we, of course, heard from Jay Powell in his testimony before Congress. And as a result of all that, we've seen those rate expectations really get ratcheted higher. This morning, there are some concerns about the banking system in some corners of the banking system as a result of one bank, which we're going to get into in a little bit. So that is also playing into some rate expectations. But that's one of the reasons why we are watching this number so closely. And again, 225,000 is the headline number that we're looking for. 3.4% unemployment, and then that average hourly earnings
potentially rising by 0.3%. As the clock hits 8:30, 311,000 is the number we get. 311,000 jobs added to the U.S. economy in the month of February, 3.6%. So the unemployment rate actually ticking higher. Remember, they come from two different surveys here, 3.6%, and then average hourly earnings rising less than estimated, 0.2%. That means on a year-over-year basis, it goes up 4.6%. A couple other things I would point out within the report: manufacturing payrolls pulling back by 4,000. Not necessarily a surprise there. We have seen more weakness in the manufacturing sector. The labor force participation rate going higher by just 0.1%, 62.5%. That's something that economists have been watching to potentially go higher here. So those are some of the initial headline numbers I'm looking at. But again, 311,000, considerably stronger than estimated, but of course not as strong as last month. And speaking of last month, there was a revision lower in the January payroll number, but not much lower, 504,000 versus the 517,000 first reported. So still seeing, on balance, Inez, strength here in these numbers.
Yeah, and just taking a look at some of the sectors and where we're at, leisure and hospitality added 105,000 jobs in February. You have employment in retail trade, which rose by 50,000 in February, reflecting a gain in general merchandise retailers. Government employment increased by 46,000 in February, about the same as the average monthly gain of 44,000 over the prior 6 months. You're looking at employment in professional and business services continue to trend up in February, up 45,000 with a gain of 12,000 in management, scientific and technical consulting services. Healthcare added 44,000 jobs in February compared with the average monthly increase of 54,000 over the prior 6 months. Construction employment grew by 24,000 in February, in line with the average monthly growth of 20,000 over the prior 6 months. Employment and social assistance rose by 19,000 in February. Transportation and warehousing lost 22,000 jobs in February. The information industry lost 25,000 jobs in February.
Yeah, and so not seeing that crack in construction yet, seeing continued losses in information given those layoffs that we've had. So it feels to me here like, yes, we have a hot headline number continuing. And by the way, when we look at the January number and why it was so hot, there's a lot of theorizing around that. Part of it has to do with weather. Part of it has to do with the increase in Social Security benefits, perhaps fueling some of, well, that's fueling spending, but also maybe just fueling the overall good feelings in the economy. I don't know. And then, but if you look at this number with the 311,000 headline, excuse me, and average hourly earnings rising less than estimated, that might not be such a terrible scenario, right? If you do have, because I think that the Fed is very closely watching that earnings number, even as they're also watching the overall earnings job growth number.
Yeah, that's right. The average hourly earnings rose by 8 cents, 0.2%, and the street had been estimating a rise of 0.3%. So not as hot as expected. But let's go over now to Jared Blickery at the Wi-Fi Interactive with a look at how the futures are reacting to this jobs report. Jared?
That's right. It looks like bad news is good news. Lots of things to get into in this report, but you can see that the net reaction is up in stock futures right now, though it's fairly muted. Let me just go to the Nasdaq here. That's up the most, about 65 basis points, and you can really see this spike up when we had that announcement at 8:30 a.m. So there was movement in both directions. There's something for the bulls and the bears in this report. We're seeing muted numbers on the wage inflation side. We're seeing muted numbers on the unemployment side. That is, numbers that you would expect show weakness in the U.S. economy, but the headline numbers is greater than expected, so that could be accounting for some of the movement we're seeing in here today. Now, let me show you what's happening in the VIX right now. We had a pretty big melt up yesterday, and let me just show you this on candlesticks. Pretty big day up there, the biggest day in months, so we could have more volatility seeping into the market. And I'm also going to take a look at the U.S. dollar index, not seeing a whole lot of movement there just yet. I'll check out out the euro as well. If we check out an intraday basis, we can see a little bit of a spike up, so a slight weakening of the dollar there, but really seeing a lot of movement in the bond market. And here's the 10-year T-note yield. This is down, well, this looks like it's break even right now. Let me go to the Treasury futures so we can get another idea. Here's a 10-year Treasury note futures. We can see those spiking up a bit. That means yields are coming down. I was just looking at the entire yield curve, not shown here, but we're seeing the 2-year, the 5-year, that's where the losses in yields are concentrated right now. They're down about 10 basis points. So that's really coming off some elevated numbers that we've seen recently. Is this pricing in a Fed pivot? I think it's too early to say. A lot of times there are fake out moves with these reports, and I just want to show you what the S&P 500 has been doing recently. This is a 3-month chart. So we sliced through the 200-day moving average. That was about there yesterday, and looks like we are potentially heading back down. This is not the movement we wanted to see to maintain this uptrend that we've been seeing here. So just from a technical analysis point of view, we've sliced through the 200-day. We have now sliced through this trend line here, and anything can happen at the close. This could be a false break to the downside, but I will close with what's happening here in Bitcoin, because Bitcoin has been highly levered to the U.S. financial system. It's been moving off these reports and has oftentimes been a leading indicator. Lots going on with Bitcoin here, but we can see there is a brief drop, and now we're seeing a rise in Bitcoin. So some mixed signals. It looks like, let me just take a quick look of what stock futures are doing one more time. We can see everything up. It looks like Nasdaq, the Nasdaq futures have managed to gain since I've been talking here.
Yeah, interesting stuff here as we look at the reaction to this. Although, oddly, I'm seeing futures down. Well, we'll get it sorted. But I want to ask you a quick follow here. You were looking at volatility ticking up yesterday, and a lot of that seems to have to do with Silicon Valley Bank, which I alluded to here, which is a bank that yesterday said it was raising capital, and it lost a bunch of money on its Treasury bets. Now, big banks, when they hold Treasuries, they usually just hold on to them until maturity. But this bank, it looks like, was forced to liquidate some of its fixed income holdings, and it's causing a big ripple effect.
Yeah, the thing is, we have tremendous volatility in the Treasury market, and that creates all kinds of ripple effects and second order effects that we can't necessarily predict. But one of them is a funding crisis at this very special purpose Silicon Valley Bank. And I would kind of liken it to Silvergate, a similar name here, because these are two specialty banks. Silvergate is crypto. This bank that we're talking about here, definitely not into crypto, but more of the VC funding game. Here we see looks like that's actually up about 0.6%, but you take a look at what's happened over the prior 5 days. This stock is absolutely cratered. I saw this stock down as much as 60%, although it doesn't look like that. It looks like it has erased those losses that I was looking at before. So pretty volatile action here. Is this any kind of harbinger of a bank run? Generally, no. I would say this reminds me of Enron and WorldCom 2001, 2002. It was a slow bleed, a slow motion train wreck when we had fallout from the tech bubble. We eventually got a recession, but there was no one big hammer that dropped. It was just kind of a steady dribble of things for years, and it was a bad time to be in the market.
Yes, it was, and a bad time especially for investors in those companies. Thanks a lot, Jared. Let's dive further into February's jobs report now with the co-founder of the Economic Cycle Research Institute, that's Lakshman Achuthan, along with EY chief economist Greg Dacko. And Lakshman, when you look at this number, as I said, heat on the headline. Yeah. But then you look at that unemployment rate and you look at the wages. How are you sort of synthesizing all of that?
Well, there's a lot. Look, you were just your colleague was just commenting, there's something in there for everybody as we dig into this data, and that'll be the case. That makes the market during the day. But to keep it simple, the headline's too hot. So this is nothing that's going to calm Powell down very quickly, or the other FOMC members. So maybe there you can dig into average hourly earnings weakening a little bit and this and that, but just that headline is going to be, it's stronger than expected. So I think the bottom line read is it's too hot, and nothing that's going to knock him off kind of the message that he's been giving. And just to pick up on the pre-announcement conversation, construction, great place to be looking. Great place to be looking. I don't think a lot of people realize that the majority of recessionary job losses, when they come, and they're not here yet, right? They're in front of us, come from the goods sector. Even though most of us work in the services sector, most of the recessionary job losses typically come from the goods sector. So that's construction and manufacturing. We see manufacturing getting tagged a tiny bit, transportation, this is all the goods kind of stuff, right?
Warehousing.
So when you go to construction, I think it's very interesting what you're onto there. And I'd almost go so far as to say, oh, who's pouring the foundation? Are they busy? Or is it the finishers that are busy? Because it's like, that's your production line. You've got this backlog of construction. Where are we in that? And are they breaking ground and pouring new things and the early stage stuff? And I'm not so sure. So we have to keep a close eye on how this propagates through the rest of the jobs market.
So what sectors are you looking at that would show weakness? I mean, we did see job losses, as you had mentioned, in transportation, in information. I mean, what is it that we're...
I would think in goods. So I would really be anything that's closer to the goods sector or that's been high flying. Okay, so obviously the information stuff has been very high flying. They hired gobs of people in the past couple of years, and so they've got to take a little off the table there, and that's what I think is happening. But the tire meets the road on the goods sector. That's where, even though it's the minority of workers, it's going to be the majority of job losses. That's how recessions work.
So, right, so can we see a recession where services is still pretty intact?
Yeah, 100. I think this is the aha moment that a lot of people don't have, is that services can grow into a recession. Services consumption may only go flat, and overall consumer consumption may only kind of flatten out, and you still have a recession. It's kind of the tail wagging the dog. And so, do we have a big come down in the real estate sector? I think that's one of the commercial real estate is something everybody's wondering about what's going on there, because the elephant in the room is that rates really went up a lot. Unexpectedly, people didn't, Powell was behind the curve, all of this stuff, so they've really gone up a lot. That's the surprise we're still dealing with from last year. And that's propagating through the economy. And I think it manifests in construction and ultimately in goods consumption.
Greg, as you look at this report, 50 basis points? What does this do to the Fed's reckoning?
I think it puts a lot of uncertainty as to what the Fed will actually do. I was saying before the report that anything north of 250,000 jobs would likely favor a 50 basis point rate hike. The reason being that Powell's testimony to Congress was very hawkish, more hawkish than perhaps he needed to be. He not just reopened the window to 50 basis point increments, but also in his signaling, in his messaging of his speech, signaled that even though he was looking at the totality of data, it was really a focus on the last months of data, which has been quite strong.
But does the unemployment rate at 3.6 and the lower wage growth, does that mitigate that impulse at all?
For me, yes. For me, what
For him,
changes the game, I think, is really what we're seeing on the wage growth front. We had 0.2% increase month over month in terms of wage growth. That is really what matters, the sequential momentum in terms of wage growth. In the end, we're not trying to fight the economy, we're trying to bring down inflation. So if you have inflation indicators like wage growth that are showing some moderation in terms of momentum, that is a very encouraging sign. Yes, wage growth increased on a year-over-year basis, but that's a base effect. Last year, wages were flat. So it's not really a sign that wage growth is accelerating. The sequential momentum is really what we have to watch for. The other thing I would note is the fact that hours worked also fell back. Revised lower for the month of January. They were very strong in the initial read, and falling back in the month of February. So we are seeing a softening of the labor market. I know the last month's data is not showing that, but if you look at the broader trend, we are seeing an easing of labor market conditions. Mm-hmm.
What do you make of the headlines of all these job losses that we've seen in tech and in other industries as well? I mean, are you not going to see as much damage to the labor market because these people are finding work a little bit easier, because also maybe they're not submitting jobless claims because they've got good severance packages for 6 months, maybe they don't have to work for another year? I mean, what is the lag effect when it comes to these high-paying jobs that are being lost?
I think we're in a unique labor market today. We're in a labor market where over the past 18 months, a lot of executives have struggled to find the right source of labor, and they're holding on to that valued talent. So they're not going to proceed rapidly with massive layoffs across the board. And I think that's why we're seeing these conflicting signals in terms of overall trends for employment. We are seeing some sectors that are softening, but no major pullback. Look at this report. You see that it's not just information. The finance sector, the professional and business services sector are seeing slower gains in terms of job growth. That's the type of environment where business executives are making strategic decisions after 18 months of struggling to hire the right type of talent and train them. We're seeing more of a hiring reset than a layoff reset, and I think that's going to be one of the key characteristics going forward.
Could I bring into this conversation this issue with SVB and the contagion that we're seeing in the banks?
While we're talking about it, I just want to mention here, the stock is halted for news pending. SVB Financial Trading is halted for news pending. We don't know what that news is. We know that the stock plunged 60% yesterday, and it was trying to reassure customers in the bank because some VCs had called on their portfolio companies to withdraw money. Others have said they were going to support it.
Pretty much a run-on bank when it comes to SVB.
It seems to be. But now the company is halted. The stock is halted.
And we're talking about SVB Financial, which is the parent of Silicon Valley Bank, and that is a bank which services a lot of venture capitalists that are out in California, a lot of startups that are in their portfolios. So my question to you is, does Jerome Powell now have more of a difficult situation if banks start to falter? And we understand that there are larger banks that aren't as exposed perhaps to this, but does this now change the path for the Fed for its next meeting?
Yeah, so I don't think so. That's a lot. It's a big question. Look, there's credit tightening. Okay, that's the path we're on, and that's the thing that all of these businesses, banks in particular, but all investors, business managers are dealing with, is that the Fed was behind the curve. They're playing catch up. They're jacking up rates really fast. They've been doing that since last year, and whatever you were holding at that time is being impacted. And some people are trying to hold it and be like, I'm going to get to the other side, and the weaker hands are starting to show up. So when it really, to really answer the Powell question, is he willing to take a recession to knock inflation down, to keep it down? Or is he willing to is he rather going to avoid a recession and risk that wherever inflation comes down to, it's not as low as is advertised by the Fed? The Fed is saying, hey, I'm going to get you back to 2%. That's my target. I'm going back there. And that's his credibility. And when you look at history, you can look at other completely different times, but the 70s, where you had inflation cycling for other reasons, and there was a great deal of political pressure on the central bank to ease when things were getting a little rough, recessions, and they gave in. And that's why Arthur Burns is kind of a punchline and Volcker isn't. And Powell is saying, I would rather be Volcker. And there was a lot of testimony back and forth yesterday about, can we lose 2 million jobs or fight inflation? What's the deal? And he said, look, there's hundreds of millions of other people being impacted by inflation. I need to fight inflation. At least that's what I heard. So I don't know what everybody else heard.
All right, we got to leave it there, unfortunately, Greg. We'll have you back soon to talk about all this stuff. Economic Cycle Research Institute co-founder Lakshman Achuthan and EY Chief Economist Greg Dacko. Thanks, guys, for joining us. Thank you. Well, as we talked about jobs growing 311,000, unemployment rate ticking up to 3.6%, and average hourly earnings rising year over year, but month over month, 0.2% here. Coming up next, recruiting using artificial intelligence, how Recruiter.com sees the future of the jobs market next.
The U.S. added 311,000 jobs in February, but as companies shift towards artificial intelligence, Recruiter.com is looking to capitalize. The recruiting company has announced a new offering, Recruiting with ChatGPT, to teach users how to recruit using artificial intelligence. Recruiter.com chairman and CEO Evan Sohn joins us now. Evan, we will get to that ChatGPT offering that you have in just a second, but I first just want to get your take because we just got the jobs report. It came in hotter than expected, depending on how you look at it, with 311,000 jobs and a couple of sectors that have seen job contraction, but overall the other ones are adding jobs. What are you seeing in the front lines?
First off, thanks for having me on your program. Look, it's a very strange market, right? You saw job numbers increase, unemployment increase, labor participation stay the same. So one would say, well, how does that actually happen? And if you look at the jobs that were created, we talked about this yesterday about the recruiter index. We saw that 40% of the jobs that recruiters were working on didn't require a college degree. So that would lend itself towards the hospitality jobs, the retail jobs that we're seeing the growth in. And if you look at the numbers in January, the January JOLT numbers, there were 1% fewer hires in January of 23 over 22, and there were 9% fewer quits between January 23 and January 22. So that means that fewer people are quitting, but the same number are getting hired. And again, these are in the millions, right? There were about 3.8 million people quit in January of 23. So 6 million were hired. So people are getting hired, fewer people quitting. That means that there's getting a tighter labor market. Tighter labor market, certainly if you're not having people participate, what we actually think is happening is that you're going back to a time where people had 2 jobs. And this was very common in the non-white skilled labor. You saw a lot of it in the remote working, people having multiple jobs. But this was common, and this came anecdotally from global heads of talent of our clients in the factories. You'd have a person working a shift Monday, Tuesday, Wednesday, 40-hour shift in those 3 days, and working at another factory Thursday, Friday, Saturday. And they had the double income, 2 jobs to make ends meet. You have inflation going up. You have higher cost of everything, eggs, et cetera. I need more money. Let me go hold down 2 jobs. And that could actually be what's happening now, is people going back to having 2 jobs. And that would make sense if you're seeing a flat labor participation, an increase in unemployment, and yet jobs are still getting created.
That's really interesting, Evan. In this case, right, do you have any kind of color through your site as to what kinds of 2 jobs people might hold? Are we seeing the double job thing move up the income spectrum at all? Talk to me about kind of the details of what you're seeing.
Yeah, so we started tracking the layoffs of industries with a partnership with Revelio Labs. We call it the layoff tracker. And in the layoffs, the percentage of layoffs from December 22 to February 23, obviously IT, about 24% of the layoffs were in IT, but about 22.5% were actually in manufacturing. The other thing we started to look at is job posts. The percentage of job posts changes from over 12-month period, year over year. So you had IT down like 5.7% in terms of job posts from a year ago to now. Transportation and warehousing down 2%, yet retail was up 4%, and healthcare up about 1.5%. So you're seeing, that's looking at the trends. If there are more jobs open in certain sectors, they're going to have more jobs available, more jobs posted now than they did a year ago. And again, I think the challenge that we all have is really extrapolating all this information, right? Because you're seeing companies post multiple jobs for the same role. If you were looking for a nurse for a particular hospital, a particular city, you might actually post that job 4 or 5 times. That city, the neighboring cities, the county, et cetera, yet there's still only 1 job that's open there. So I think there's a real interesting way to look at all this information, and I think it's going to evolve.
And going off of that point of posting a job multiple times, I mean, are these jobs hard to fill? When you're talking about services, hospitality, retail, how hard is it for employers to fill them?
Yeah, so you're certainly seeing that in healthcare. Healthcare has its own challenges. There's credentialing and licensing and background checks and all these other things that sort of happen in the healthcare space that adds complexity there. I think people were having trouble not filling them, but keeping them. There was a much bigger, in 22, a much bigger quit rate. We're still seeing quit rates above where they were in 2019. So we're still seeing a higher quit rate, but that's really the challenge. And I think the segment on right before, talking about retention. And we've been predicting that 23 is a really big conversation around how do you keep employees from leaving. It's so easy to apply for a job. If you think the difference when, 40 years ago, if you applied for a job, you printed up a resume, you mailed in the resume, or you looked at a classified ad, you phoned it in, you went in and out, it was a process. It was a much more elongated process. Today, it's click, 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 click. It's very easy to apply for a job. So companies are being inundated with applications. So that's not really the challenge. So on the one hand, it's the challenge at the top of the funnel, making sure you have qualified folks that align with what you're looking for, but it's also about keeping them. So really reducing this great resignation that started really post-pandemic or in the pandemic, followed by the job hopper economy where people moving around from job to job.
And you also want to get the best person for the position. And apparently you guys are working on using or helping people use ChatGPT to write the posts. So how does it help? How is it helpful?
Yeah, so the first is we announced and launched recruiterclasses.com. So there's a real need for recruiters to always improve their overall skills and improve their ability and their learning ability. And we launched a platform with the first course in it was how to leverage ChatGPT, really just off the shelf ChatGPT, how to leverage it and use it. That's a class that's available. We now have, it's a third-party platform also, so meaning we have third parties writing classes to go into this platform. We just added our next one for big wins for executive recruiting. And so we're going to continue to make tools and make it easier for recruiters to do their job. The challenge today is that companies have laid off lots and lots of recruiters. So many recruiters are being asked to do more with less. And ChatGPT as a technology, we could train people on how to use it to really help them do things like writing job descriptions, et cetera. And you'll see other things that we're working on regarding around the technology. We've always been at the forefront of helping recruiters. We are recruiter.com, a destination site for recruiters and for the companies and individuals looking to seek out recruiters. And so we're going to continue to make investments to really help recruiters do their jobs, better, stronger, and faster.
And people finding lots of creative ways to use ChatGPT these days, for sure, amongst all the other stuff you were talking about. Recruiter.com Chairman and CEO Evan Stone, thank you.
Thank you.
Quick recap of the jobs numbers. 311,000 jobs added to the U.S. economy last month, but the unemployment rate, on the other hand, ticking up to 3.6%, and wages rising a bit less than estimated, 4.6% year over year, 0.2% month over month. What does that do in the futures? We're actually seeing some strength in the futures here this morning, perhaps because of that wage number. We're going to talk a lot more about all of this over the next couple of hours. And coming up next, we'll share the top 3 things you need to know today, including a deeper dive into Silicon Valley Bank, who, as far as I know, shares are still halted. We'll be right back. Good Friday, good jobs morning. I'm Julie Hyman with Inez Ferre in for Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, February's jobs report came in hotter than expected, at least on the headline. Non-farm payrolls up 311,000. That's higher than the 225,000 that economists were expecting. The unemployment rate, though, ticked up. It came in at 3.6%, slightly higher than expectations. Importantly, there was a smaller than expected gain in wages during the month. Average hourly earnings rose 4.6% from a year ago, below estimates, and potentially some good news for the Fed in its battle against inflation. Second thing you need to know, bank sell-off sparked by Silicon Valley Bank. SVB said yesterday it lost $1.8 billion on the sale of U.S. Treasuries and mortgage-backed securities. The news coming as SVB announced it was raising $2.25 billion in a share sale. Concerns about the bank's solvency led some startup advisors, including Peter Thiel's Founders Fund, to advise portfolio companies to withdraw funds from the bank. That's according to Bloomberg. The timing, alongside the collapse of crypto bank Silvergate, is raising concerns about a wider contagion. And third thing you need to know, Gap's struggles continue. The retail giant swung to a loss in the fourth quarter. It also issued a full-year sales forecast well below Wall Street's estimates. It's been a rocky time for Gap, dealing with weaker sales, excess inventory, and a messy split with rapper and designer Ye. Sales declined across all of its brands, including Old Navy, Gap, Banana Republic, and Athleta. The company's still searching for a new CEO as it looks to rebuild itself. Well, February's unemployment report came in hotter than expected. The economy added 311,000 jobs. What does all this mean for the markets and for the Fed? Let's bring in Principal Asset Management Chief Global Strategist Seema Shah to discuss. Seema, it is great to see you. We're actually seeing stocks turn up a little bit here in the U.S. in the wake of the report, and I wonder if it has to do with that wage number. How are you reading it, and what is the read-through for markets?
Yeah, thanks, Judy, for having me on. Yeah, it's an interesting report. So I think the market is focusing not on that job, that 311 increase. They're really focusing on the average hourly earnings. They're also really looking at that unemployment rate, saying it's larger increase than expected, which is telling us that maybe the labor market is loosening a little bit. I mean, we have to put it in context. 3.6% is still an incredibly low unemployment rate. But at least at the margin, you are seeing potentially a slight loosening. And it does suggest that maybe the Fed doesn't need to hike by 50 basis points later this month.
And that was my question. Do you think that the Fed will be hiking by 25 or 50 basis points, or do you think it will also need the data coming out next week to determine what happens?
Yeah, Powell, he's had a couple of confusing messages, but he was very clear about one thing when he spoke at the testimony, which was that the data between now and the March meeting are incredibly important. They are very much a data-dependent Federal Reserve at the moment. So this jobs report was, of course, one segment of it, which is very important. But given that the jobs report hasn't really given us a very clear picture of what the economic situation is, we're now looking to the CPI inflation number. And that as well is going to be very important to decide, is it going to be 25 or 50? At the moment, I think it's fairly balanced. We can see from the Fed narrative that maybe they are starting to move towards the slightly more hawkish side, towards the 50 basis points. But given that they had just stepped down to 25, I have to assume that there's a slightly high hurdle to get to that 50. So if we do get a CPI number which is in line with expectations, or certainly softer than expected, then I think that 25 basis points is back on the table.
What is the game plan then for investments, right? If there is the potential here, whether it's 25 or 50, we know the Fed's going to keep going. That's what Powell has indicated. Does that ramp up the recession risk? And then does that mean markets are or are not appropriately pricing that in?
Yeah, Julian, I think you said the really important thing here. We're talking about the 25 and 50, but really the big picture is that we know that the Fed is not going to be stopping in their rate hiking cycle for the time being. We know that they've got further to go. The other very clear message that has come out from the Fed is that they don't expect to be cutting rates at any point in 2023 because they just simply don't have the inflation space to do that. So then, you have to turn to investment markets and say, look, well, the equity market has been railing fairly hard through much of the start of this year. And it seems like it hasn't taken full appreciation for the fact that the economy will eventually feel the negative repercussions from these rate increases. So to us, that means that earnings growth is going to be challenged as you get further through this year. It means that margin compression is going to be a really key theme here. So companies are going to be struggling more and more. So for us, putting that together, that suggests that equity markets probably are in for another leg downwards. And it's really important that investors start to look at their portfolios and try and seek some kind of safety, safe assets within there to balance out the risks that they have.
Seema, if companies are paying more for workers now, even though we did see that wage growth slowing a little bit, I mean, could we be seeing a recession where you still have a relatively strong labor market, at least in some areas?
That's very true. So, you know, from our forecast, when we look at the unemployment rate today at 3.6%, we're only expecting it to rise to around 4% by the end of this year. It's still a very, very low unemployment rate. So it's not going to feel anything like what we've seen in previous recessions. You know, this isn't a downturn that we're expecting to rival anywhere close to what we saw for the Great Financial Crisis. And as you said, there will be certain pockets of the market, of the economy, which will probably fare okay. We think that services is the area which may be relatively unscathed, manufacturing probably a part which is more interest rate sensitive. So there will be pockets which will not suffer as much, but from the aggregate side, we do think that recession is unfortunately going to hit the US economy late in 2023.
Seema, stick with us because we want to turn over to this. There's concerns over the stability of the financial system. They're back in focus. Shares in Silicon Valley Bank, also known as SVB, nosedived yesterday, causing a ripple effect for global equity markets. Major financial institutions in the US, Europe, and Asia have been the worst hit, really. Shares in SVB were up in pre-market before being halted pending news. Now, SVB is a key source of funding for tech sector startups. It also holds a lot of Treasury debt on its balance sheet. When the Fed raises rates, the value of those bonds fall. And yesterday, the bank said it was issuing shares to raise money and cover those losses. That set off alarm bells. The announcement came amid the collapse of crypto-focused lender Silvergate, and a nervous market is now seemingly questioning balance sheets across the banking space. You can read all about it in the latest in today's morning brief, written by Miles Udland over at the Yahoo Finance homepage. Let's get back to a principal asset management chief global strategist, Seema Shah. So Seema, looking at all this and what's happening with bank stocks this morning, what was happening yesterday with SVB, what do you make of this? I mean, are we looking at a failure in banking, in just regional banks, in banks that service startups? What do you make of what's happening?
So look, I don't want to exaggerate the situation. You know, it's very difficult to ever know how far the ripple effects are going to go. I think that what we can say is that, look, the banking sector is probably going to be a part of the economy which could be challenged. We have an inverted yield curve, which is always a difficult situation for banks. We have a growth environment which is likely to deteriorate as we go through the year. So there's going to be a lot more loan provision, bad loans starting to come through. So this is going to be a challenging time. And on top of that, in this specific situation, it sits in a difficult part of the market, kind of a troika of banking industry, technology, which we've already seen has been very challenged, and then a bit of the private space, which maybe hasn't seen any of the kind of the catch up that we are seeing from public markets. The other part of this is that, look, when you have interest rates rising as quickly as they have, and remember, this is the most aggressive Fed hiking cycle since the early 80s. When you have rates rising this quickly, inevitably some things will break. We have to expect that. It's very difficult to anticipate where it's going to break, but some of this is to be anticipated. And from here on, it's only going to be a question of just seeing how far the ripple effects go. But I want to say, look, there are banks, and you know, of course, there's always going to be some banks in the US which are weaker. But broadly, the US banking industry is fairly well capitalized. So we're not looking at a major financial system collapse by any means at all. So it is going to be looking at day by day, but we know that there are difficulties coming ahead. But again, this is not going to be anything like the Great Financial Crisis.
And Seema, I'm glad you're sort of making the distinction here. And just for our viewers to sort of explain here, this particular bank, which seemed to have held treasuries, mortgage-backed securities, according to reports on its balance sheet, a big bank probably holds that stuff too. The difference is a big bank doesn't necessarily need to sell those before maturity in order to raise cash, which appears to be what happened in this case, right, Seema? So, I guess, is there any way of sort of finding the other corners of the financial markets, of the financial system that are at risk before we see them, before we see another Silicon Valley bank or what have you?
Yeah, inevitably analysts are going to be looking out for which of the banks which display similar characteristics. And as you rightly said, this is somewhat specific. This is not a factor which we should expect for the whole banking industry to be exhibiting by any means. But unfortunately, with markets, the way that they do work is there will be inevitably contagion. You can see that not just in the US banking sector, but even the European banking sector, which up till this point had actually performed extremely well. We have to just wait and see, but inevitably, yes, analysts are going to be looking out, seeing which other banks have the same characteristics, and those ones are going to be probably the more vulnerable out of all of them.
And I mean, as far as vulnerability, do you think that this could, if this bank is having such problems, are there going to be also other banks, but related to tech, related to the VC world? I mean, could this be sort of a major stress when it comes to the VC world and its portfolio companies, which are startups, which often are not profitable perhaps yet, which are burning a lot of cash?
So, as I said, it is difficult to ever know how far the ripple effects are going to be. There will be eyes on the industry inevitably. And many of them haven't had, of course, the same impact as we saw in public markets last year, which mainly means that they're due, or it could suggest that it's a sturdier part of the market. Sometimes a lack of liquidity is a good thing because it means that you can just ride out the storm. As we know, for markets, it's time in the markets, not trying to time the market. So I certainly, for private markets, that is always a benefit. Unfortunately, at this point, I think it's very difficult to say. It's just something that we need to just watch out for. But I think that this is, if anything else, this is just alerting everyone that, look, when you have interest rates rising as quickly as they are today, there will be some areas of the market which will really start to struggle. And as we came into 2023, I think most analysts were aware of that and trying to figure out where that next pain point would be. And unfortunately, it does look like one of the areas is this one.
And Seema, finally on this topic, when you're talking to clients, is there any advice you're giving them in light of these events as they unfold in terms of how they should be looking at their portfolios?
In a way, so one of the things that we have been saying, so this is just a kind of a reiteration of the message that we've been giving for a couple of quarters now, which is that within your portfolios, we need to be looking at which are the sturdy businesses. It is not the time just to kind of go into one index and hope for the best. There will be nuances within each sector, which are going to be very, very important. This is the time to be looking for high quality assets. Look at where they have the sturdy, which ones they're going to be able to withstand the increasingly difficult economic environment. We do think that you should have an increased number of treasuries, investment grade credit, things which essentially should perform well, or at least better, as the economy starts to struggle. So this is the time to really revisit your portfolios and make sure that you have got safety and defensive elements which are going to carry you through what could be a couple of stormy months.
Seems like a good idea right now. Seema, thank you so much for being here. Principal Asset Management Chief Global Strategist Seema Shah. Appreciate your time this morning. And there's one more tidbit, folks, that I just want to bring you on SVB. CNBC is reporting, according to David Faber there, who's citing sources familiar, that the company had tried to raise capital. In fact, that it also had tried to sell itself, and that the capital raise had not worked. And so now the company is potentially looking to sell itself. And according to CNBC, large financial institutions are looking at a potential purchase. And even as we speak, the shares of the company are still halted pending some kind of news. Of course, we will be monitoring it. We don't know what that news will be. Gap is taking a hit in pre-market after reporting a $273 million net loss in the fourth quarter, widening from $16 million a year ago as it deals with slowing sales and several executive shakeups. The retailer is still searching for a permanent CEO. Interim Chief Executive Bob Martin says the board is closing in on a final decision. We're going to do a deeper dive into Gap's earnings report later on in the show.
As we continue to chat Jobs Day and the state of AI, we're joined by Jefferies Aniket Shah. Aniket, thank you so much for joining us. So, taking a look at what we saw with the jobs report today, we saw 311,000 jobs that were added. We saw unemployment tick up a little bit. But AI is also it also plays a role when it comes to people's sort of nervousness about their jobs as well, and about holding those jobs. So what can you tell us on that front?
Thank you. It's really great to be here. We have been looking at the future of work now for the last couple of years. And since the start of COVID, a lot of business leaders and investors have been thinking about whether people will be working inside the office, whether they're going to be working remotely. And that was, of course, a major topic for business leaders and for investors. A few months ago, with the advent of ChatGPT, we have started a whole new chapter of this saga, because ChatGPT has fundamentally impacted the imagination and the nervousness of many office workers. And what we're seeing in our survey work, in our conversations with investors and business leaders, is that workers are worried about automation replacing their jobs and AI replacing their jobs. And if they actually have used ChatGPT, they are even more worried about that. And they're looking to upskill their work, and they're looking to upskill themselves. And that has all sorts of investment implications for businesses and investors.
Aniket, there's been so much talk and hand-wringing about all of this. Like, you've probably used ChatGPT. I've used ChatGPT. It ain't doing my job. I mean, yes, at the margins, there are some tasks it can do. But I don't know. Is this whole thing, I understand that people are worried about it. I get that, and I understand that concern. But is it a little overblown?
People have been concerned for 300 years about technology replacing their jobs. This is nothing new. The Luddite movement was, 200 plus years ago. And since then, the economy has kept creating more and more jobs, and technology has actually just helped us become more productive. And it's helped us do the things that we don't want to do and focus on the things that we do want to do. So I'm always very nervous to say this time is different. What I will say, though, is that ChatGPT did strike a nerve. I think the immediacy of the technology, its ability to potentially replace a lot of high-paying white-collar jobs, has also been slightly different than other types of technologies and automation plans. And by the way, we're operating in such tight labor markets that this could be, that could help, frankly, kickstart the rollout of ChatGPT and technologies like it even more. So if you ask me, I'm not necessarily concerned about mass unemployment because of AI and automation. I think we will create new and different and more creative jobs, but it will require a change in skills for workers. And it'll require companies to think about how do they use their resources differently.
And Aniket, you just touched on something really interesting, which is the sort of class bias inherent in this latest Luddite craze, if you will, or technology craze. That is, the Industrial Revolution affected manufacturing workers and farmers, right? This here, we're talking about higher income workers, information workers, white collar workers, which is a really fascinating twist. I don't even know what my question is about that. I just think that's a really fascinating observation, and there are some different implications based on that. Does that mean this is going to be managed better because there are different people paying attention to it?
Well, I don't know if it's going to be managed better, but it's certainly going to have much more attention from journalists and business leaders and investment strategists like myself, because it's impacting a different social class. And frankly, associated with that is just a different quantum of capital and of economic activity that this could impact, right? We're talking about the financial services industry. We're talking about media. These are multi-trillion-dollar industries globally. So I think that's what makes it different. And I think what also is happening, as you know very well, is this is all happening at the same time that there is a rethink around higher education. There is a re-examination of whether colleges and universities are giving workers the skills that they need. As you know, over the last few years in the United States, from both presidents and both parties, Republican and Democrat, there has been a re-examination of whether the four-year university is actually giving the skills that we need. We've seen recently the governor of Pennsylvania has removed the college requirement to work for the state of Pennsylvania. We're seeing that as a trend that is evolving everywhere. So business leaders and governments are rethinking what are the skills that are needed, what are the ways people get those skills, and the AI discussion is part of that. I want to highlight one of the charts that you just put up right before, which is, I think, incredible. When workers saw ChatGPT as part of our survey, and if they were thinking about skilling themselves, a large percentage of those workers said, I'm actually going to use alternative educational efforts, not just college and higher education, in order to grow their skills. This is upskill and reskill resources. This is taking certification exams. This is internal corporate learning, which, by the way, is a $300 to $400 billion a year industry. This is taking a boot camp. And you add up all of that, it's much larger than the number of folks who say, you know what, I'm going to go and get a master's degree, or I'm going to go and get an MBA. And that to us is a big trend that we're just in the very early stages of, because college is becoming highly unaffordable for many workers, and there are better alternatives out there. And I say this as someone who teaches at a very prominent university here in New York, but I think we really need to rethink the future of education, and AI is going to be one of the key drivers to do so.
And so, Annika, quickly, when you rethink that future of education, I mean, coding is something that my 13-year-old nephew is learning, but is coding now, if you're going to have everything automated, should he be learning coding?
The amazing thing about technologies like ChatGPT is they can basically learn how to code on their own. I mean, it is the self-learning element of AI, which I think is most interesting and potentially most transformational. So we have no idea of what will the skills of the future be, but I will say, as a manager in my day job and as someone who studies this topic deeply, the most important skill one can have is, can you learn a new skill? And I think the ability to learn new things and learn new things quickly is going to be a value that is going to be a skill that is highly valued in the job market going forward.
All right, Annika, really fascinating stuff. Sorry, I was ruminating, and that's why I didn't thank you right away. Jefferies Global Head of ESG, Annika Shah. I hope to talk to you again very soon on all of these really fascinating issues.
I look forward to it.
Thanks. Should I still sign up my son for coding next year? Coming up, Oracle is sinking today following its third quarter earnings report. We'll explain why and have the opening bell on Wall Street next. Coming up on the opening bell on this jobs day, and here are the jobs numbers that we got just about an hour ago. 311,000 jobs added to the U.S. economy last month. Remember that blowout number in January? It was revised down, but just to 504,000 from 517,000. So still strong jobs growth for another month. 3.6%, the unemployment rate taking up 0.2%. And the wage growth cooling slightly, up 4.6% year over year. That's a little bit less than estimated, up 0.2% on a month-over-month basis. What does all of that mean for futures? Mixed picture here this morning. Dow and S&P futures pointing to a lower open, Nasdaq futures pointing to a higher open, and the opening bell on Wall Street here on Yahoo Finance, sponsored by Tasty Trade. Why are we seeing markets mixed here as we have that bright yellow opening bell here this morning? Well, it looks like people are trying to game out a lot of different aspects that they are now weighing. Of course, they're weighing and trying to game out what the Federal Reserve is going to do next, because on the one hand, strong job growth. On the other hand, a little bit weaker wage growth than estimated, which is good news for the Fed's quest to fight inflation. So that's happening on the one side. On the other side is what's been going on at Silicon Valley Bank and the turmoil there and what that then means. Are there any implications for the broader banking sector? There are a lot of questions about that this morning. It doesn't seem there are a lot of answers, but, we talked to Seema Shah a little while ago. She said it doesn't seem as though this is going to be a widespread issue. She said pretty clearly and definitively, and this feels right, this ain't the financial crisis, right? This is not something of that magnitude that is now unfolding. And I think, it's safe to say stocks reflect that as we open up this morning. They're down, but we're not seeing a big hit.
Yeah, that's right. We're looking at a little bit of a mixed picture when it comes to the sectors right now. We're seeing financials are down, technology is down, materials is down as well. But you're looking at consumer staples and utilities that are slightly higher. You've also got healthcare that is relatively flat. Over on the Dow, we are seeing a mixed picture here with the Dow. You've got McDonald's is up more than 1%. Intel, as the chips today, are seeing some gains. I want to point out the Nasdaq, which is mixed as well. We're seeing the mega caps, they're a little bit flat or down just slightly. But then we are seeing Tesla up 0.5%. Let's take a look at where we're at with those banks that we were mentioning. So you are seeing banks that are under pressure. Some of these under pressure more than the others. The bigger banks are not losing as much. But I want to also point out where we're at with the regional banks. We've got the regional chart here. And you can see the regional banks are under pressure as well here. So SVB is somewhere here as well. And you also have USB that's down more than 3%, US Bancorp, and PNC is down more than 3%. So the regional banks are the ones that right now are seeing some of the losses. But just going back to see where we're at with some gains, I do want to point out, as I mentioned earlier, that we're seeing some gains when it comes to the semiconductors, ASML up more than 1%, AMD also up, Broadcom as well.
Yeah, I mean, can we drill down into those banks a little bit? I know we have the regional banks somewhere on the heat maps here. And the reason it seems that the regional banks are suffering a little bit further is just concerns about, I guess, whether their balance sheets are in different shape than the biggest banks. But really, regulators, ever since the financial crisis, right, we do these stress tests. The regulators try and figure out, and make sure that all of these banks are well capitalized. But you look at the likes of a Zion Bancorp. I don't know if you see that one, Inez, but that is down some 20% here. Or
this
now
is
11%.
Over a two-day chart. It's down. It's down 11%. But I've just pulled up the two-day chart so you can see. Actually, the regional banks were also under pressure throughout the week as well. So if we just
because
pull
of
up
the inverted yield curve.
Exactly. Right? So if we pull up a 5-year chart, you're looking at quite a bit of. 5-day chart. You're looking at quite a bit of pressure with these banks. But today, let's look at the intraday. You're seeing some Zion down 10%. You're also seeing PacWest Bancorp down 24%. So some of these banks that you may not be as familiar with, these banks are seeing most of the losses right now.
Yeah, exactly. We're going to keep monitoring this, of course, throughout the day and figure out what's going on here, even as those SIVB shares continue to be halted, and we don't know what the news pending is going to be on that company. Let's take a look at some other movers. Gap is one of them. The stock is down 8.6% after missing estimates in its latest quarter. The retailer saw a wider than expected loss, net sales down 6% compared to last year. Gap also seeing trouble ahead, estimating first quarter net sales decreasing in the mid-single digit range. And the company already made some management changes, right? Sonia Synagel was out as CEO. Bob Martin, who was one of the controlling family of the company, stepped back in as interim CEO. They don't have another CEO. He said it's close, but in the meantime, they're mixing up some other roles. The head of Athleta is out. That had been an area of strength for the company, not so this quarter, where it saw a decline in comparable sales. Also out, I believe, is the chief creative officer. So, they're trying to do a bunch of stuff to get things back on track.
I mean, they were already struggling, and through the pandemic as well, supply chain issues. They've had issues with styles over the last year. So you're having already these compounded problems, and then you've got as well as this management sort of shakeup that you're seeing, and also the outlook that they gave, saying that it's based on the continued uncertain consumer and macro environment. So any which way that you slice it, Gap has been struggling to come back to profitability, and it's got the management issues, and it also has the issues with the consumer as well, and the performance of their product. So all around, you look at it.
Some of the analysts have said maybe things are going to get better from here. Inventory looked a little bit better. One of the people who watches this company very closely is our own Brian Sozzi, and he filed this take on it.
Another bad earnings report for Gap. Here are 3 signs I saw in the company's earnings report that the company has just flat out given up. First off, inventory down 21% year over year. If you are a retailer with any sense of strength or health, you're buying inventory so human beings can go and buy a shirt. Gap not doing that. Next up, Gap canned its chief growth officer and its chief people officer. These are 2 important positions that if you are a growing company, you need a growth officer and you need a people person to manage all the people you are using to grow the business. Gap not doing any of that. And then last but not least, Gap coming out here with another $250 million in cost savings. If you are a healthy company, you are not cutting $250 million in costs. I have a bigger story on the complete failure on Gap now on yahoofinance.com. Check it out. Brian Sozzi out.
And part of that cost savings, by the way, is from the removal of some of those jobs. Just wanted to mention one thing on the inventory front. All season long, really longer than that, we've been monitoring all these retailers who have had big increases in inventory. And then, as our Miles Udland wrote earlier in the week in a morning brief, inventory levels seem to be normalizing for most retailers. That is, many of them are still seeing increases, but they're not seeing the high double-digit increases that we were seeing of several months ago when they were caught flat-footed as consumer spending patterns changed. So again, as Sas pointed out, to see that inventory drop really does make Gap an outlier in this environment.
And we're also taking a look at shares of Oracle this morning, under pressure after it fell short on analyst revenue estimates for the third quarter as net income slid 18%. And just taking a look at some of the reaction from the street when it comes to Oracle, JP Morgan has an overweight rating on the stock. JP Morgan says that while macro headwinds may materialize, demand appears somewhat stable at present. BMO Capital, also market perform rating, saying this was a solid if unspectacular quarter. Some interesting points to note that that Oracle has had some large cloud deals, including one that was announced with Uber. You also had Bloomberg Intelligence's Anurag Rana saying, we continue to believe the company's navigating the slowdown better than large rivals. So a mixed picture when it comes to some of the...
I mean, a slowdown is a slowdown, I guess, and that's why the stock is down today, despite the numbers actually coming in above what most of these analysts were anticipating. So, I don't know how you slice it, really, when you look at these Oracle numbers. It's also interesting that the company raised its dividend 25%. I love this. In the statement, the company said, Larry Ellison, who also happens to be the company's largest shareholder, quote, did not participate in the deliberation or vote on this matter. He didn't vote to return cash to himself. He wasn't a party to that. I just thought that was a funny little note there. But the dividend going higher doesn't seem to be helping the stock today either, which is also kind of interesting there. And finally, moving on to one more mover that we are watching, and that is Allbirds. The shares are sinking after the company missed estimates in its latest quarter. The footwear and apparel company saying net revenue just decreased 13.4% as gross margin declined to 43.1%. You know, Allbirds is one of these companies that was the class of 2021,
2021
I believe.
IPO.
Yeah, you know, and so this company came public at $15 in November of 2021. Pretty much the worst time they could have done it, because guess when all of the thirsty cash companies peaked? November 2021. And so it was kind of straight down from there for Allbirds.
Well, and also, you know, it's a kind of this cool brand, but just taking a look at some of the commentary that is on the street. Piper Sandler has a neutral rating saying that Allbirds continues to struggle with highly competitive performance sneaker market, as well as a poor reception to new products. You also have Telsey Advisory saying, basically calling the fourth quarter poor, saying that the results miss consensus expectations. Allbirds provided negative, significantly lower than anticipated outlook for first quarter of 23.
I mean, it just seems like, bottom line, they're not selling as many sneakers.
And when it comes to retail, I mean, we've seen this over and over. You also have to question how many sneakers does the consumer need right now?
Yeah, that's a good point.
And we're also watching shares of DocuSign plunging today despite posting an earnings beat. We'll break down that report and why the stock is in a free fall later on in the show. Coming up, Bitcoin is setting up for its worst week since the collapse of FTX. We'll explain why next. Stay with us. Bitcoin is sinking below $20,000 today to its lowest level in nearly 2 months as Silvergate's liquidation and wider stock market losses hit the digital asset. Yahoo Finance's Jared Blickery is at the Wi-Fi Interactive with the details. Jared.
Yes, let's first check out the price chart here. This is Bitcoin's price reaction. It got a number of moving parts. Let's just start with today, or actually this is 5 days, so we can go back in time on Tuesday and Wednesday. That's kind of when we got more information about what Silvergate was going to do, and it's winding down its operations. This was a funding bank for the crypto enterprises, a lot of which have failed, and this is just kind of a prelude to what happened in Silicon Valley yesterday with Silicon Valley Bank. Now, we also had Powell speaking Tuesday and Wednesday. It's hard to see here, but this little spike down came on Powell's testimony, and then it was kind of down, a slow drift down from there, the bottom really falling out yesterday. In the context of the larger price rally that we had seen earlier in the year, now looking pretty much in jeopardy. This year chart shows that essentially Bitcoin had been trading in a very large range, or a long range. Looks like the touch isn't annotating right now, but the 25,000 level was something that we reached last August. And then down here we have the bottom, what is that, 15,000, 16,000? So would be very easy to see this $15,000, $16,000 level traced out right here. Until we move above 25,000, probably not going to mean much in terms of price action. And 30,000, what you see right here, that is a real delineator. Now, if I sort by performance here, looks like my screen is frozen, and that's why we're not annotating. So it looks like I'll just have to wrap this up here. Lots going on in the market, also with Bitcoin. I would imagine the Bitcoin stocks as well, crypto exposed stocks especially, getting hit today, guys.
All right, there's a chart for you behind you.
There we go. Thank you.
The 5-day.
Yes.
I don't know if we can try on this one either. Jared, without drawing ability.
I know. My hands are tied.
Jared, thank you so much. Coming up, shares of DocuSign are plummeting despite an earnings beat, but they got a price target raised from Wedbush on what it calls a step in the right direction. We'll get the view from Wells Fargo next. Shares of DocuSign are plummeting despite fourth quarter results overall coming in above expectations. Investors are looking for improved margins following staff reductions last month. Wells Fargo Securities Managing Director Michael Turin joins us now. Michael, the issue here seems to be, at least in part, the billings, right? Which sort of is a little bit forward-looking in the first quarter billings forecast. What is going on at DocuSign? It just seems to be struggling to right the ship here.
Yeah, first, thanks for having me on. I think what DocuSign is struggling with is what a number of companies across software are struggling with, which is you captured a lot of growth in a quicker period than was expected during the pandemic. Obviously, there was a critical need for DocuSign a couple of years ago that led revenues up to $2.5 billion. And a lot of companies weren't quite geared appropriately for what's next after that. I mean, this is a company that had 4,000 employees before the pandemic. That number effectively doubled to 8,000. And you're seeing just a recalibration period happening. So it just feels like this has been consistent across a number of software companies. It's more pronounced in companies like DocuSign because of the acceleration that happened. And they're just attempting to get back to more stable footing. And you're seeing a lot of changes, which are leading to some frustration from investors just alongside that.
And Michael, part of the changes are management changes. You've got a CFO transition there, a restructuring. There were layoffs announced in February. So how long will these sort of changes take in order for DocuSign to get its footing back?
Yeah, I mean, usually it's around 9 months is the general software playbook on this. You have to think about someone comes in, they have to learn and observe what's happening, figure out where they want to make change, and then generally bring on a new team to help facilitate that change. With DocuSign, you saw a new CEO come on board in September. You've since seen a new COO and president of the company come on board in January. And I think the wild card that investors weren't necessarily expecting here was CFO transition also announced last night. So you have a number of moving pieces that to us suggest it's more likely towards the end of this year than sooner when you start to see all of these pieces line up and just a better, more stable footprint from DocuSign going forward.
What is, in your estimation, what does fundamental demand look like for DocuSign services?
I mean, it's still healthy, right? I mean, we all still have use cases that we think about where there could be digitization and it hasn't happened. You think about some of the more traditional industries, public sector, other areas, they're still far behind. So DocuSign's still adding customers. If you want to take a more optimistic view, they're still adding 30,000 customers, even over 1 million customers in an environment like this. They're still showing some degree of expansion, although much more modest than we've seen historically at 107% expansion rates. So I think there's still ongoing demand. It's just the pace of that is challenged right now. And intuitively, you can kind of see it, right? If you think about sales activity or employee activity or mortgage activity, some of the use cases that DocuSign is tied to, all of those are not in the same positive state that they were 18 months ago. So there's a scenario where these things start to move in a more favorable direction for DocuSign. But right now, it's just not the case. And so I don't think this is as much a demand issue as how much can you capture and just what's ahead in an environment like this that's challenging them.
And speaking of challenges, I mean, as we go through this year and the Fed is expected to continue tightening, what is that going to do to companies like DocuSign?
Well, I mean, the negative case would be this starts to put companies out of business. And if companies go out of business, then that's going to hit someone with as far-reaching a customer base as DocuSign. The positive case would be this is a quick ROI, efficiency-based play. We all know that overnighting things via FedEx to make sure that they're signed and back to you is a much more costly endeavor. So, there is a world where I think DocuSign can find some ability to still sell their products, but certainly not at the elevated growth rates that we saw, right? This was a business that was growing around 30% pre-pandemic. Those growth numbers hit 50, 60% on the back of COVID. And as you get to bigger numbers, the growth rates naturally decelerate. So now we're talking about 14% growth in the current quarter and shades below 10% for the coming year as what's currently forecast.
You know, Michael, that's part of the reason we actually wanted to talk to you today, not just DocuSign's earnings, but we're coming up on, amazingly, the 3-year anniversary of the pandemic shutdown, right? And this is one of the companies that was sort of emblematic of that period of time and the elevated growth rates that you're talking about. You cover a lot of other ones. Zoom, I see, is on your coverage list, for example, as well. So you cover a lot of these pandemic darlings. Is there one, and so many of them have now come down and have been struggling, et cetera, in the wake of that, and tried to get back to normalization. Are there one or two that stand out as having really done a good job of managing that transition?
Well, the more mature companies are doing the better job, right? So this is where you can look at a contrast to someone like Salesforce, and you can argue that there were a lot of forces pushing them in a different direction. But I think the reaction for DocuSign stock here would be quite different if they were pushing margin more aggressively. This, you could argue, is one of the more efficient businesses in software. Its margin structure could be potentially Adobe or Salesforce-like. Again, the challenge a lot of these businesses are facing is that it's the same management team that was prioritizing growth coming into the pandemic and at a much smaller scale is now being asked to manage an employee base that's 2 times the size of what it previously was and get to a true operational framework that most of them haven't had to see yet. So the bigger, more mature companies that have seen cycles are the ones that are navigating this more effectively. If someone like Salesforce is effectively pushing their margin from 20 to 30% very quickly, and that is a very comfortable offset for investors if top line growth is slowing. So those that are able to kind of lean into the bottom line with a little bit more strength are those that are getting a little bit more credit in the market currently. And there's just a younger generation of companies where this is kind of the first real macro challenge that they've seen, and generally that takes time to calibrate around and often a shift in the management team.
Michael Turin, thank you so much. Wells Fargo Securities Managing Director with an equal weight rating on DocuSign and a price target of $60 a share. Thanks for joining us. Coming up,
very much.
We'll speak with Labor Secretary Marty Walsh on his last jobs report day. You won't want to miss that. Stay with us.
Welcome back to Yahoo Finance Live. The leisure and hospitality industry adding 105,000 jobs in February. The sector, it's been a hot topic of conversation for Labor Secretary Marty Walsh.
What was hopeful to me today was the hospitality restaurant numbers, because that's the industry and that's where the workers are. That number is not where we want it to be. We saw some good growth in the beginning, in the spring, if you remember, April, May, and June, if I'm correct. We saw some good numbers in the hospitality industry and the bar industry, where people are coming back. And this month we didn't see those same gains. That's the sector that hasn't come back fully. There's still a lot of people that were pre-pandemic work in that sector that haven't come back to work.
You know what? We're looking back at all of this Marty Walsh footage because he's coming to the end of his tenure as Labor Secretary. Remember, he's leaving to be the president of the NHL Players Association. And coming up, we've got a farewell interview with him, Labor Secretary Marty Walsh. Now, we'll be talking about what he's achieved during his time there at Labor. That's coming up on the other side of the break. Welcome back to Yahoo Finance. I'm Julie Hyman with Inez Ferre. Let's take a look at the market action as investors continue to digest the latest jobs report data and potential problems at Silicon Valley Bank. Here we go. Let's take a look at the S&P 500 first of all. I'm looking at a 5-day chart and the 3.5% decline that we've now had on the week. If you look at the intraday here, we really have seen a lot of bouncing around during the session as investors are sort of trying to figure out how to play things here. The Nasdaq is performing the worst today. It tends to when you see rate expectations ratchet up, but there's more going on here, and I just want to detail what's happening. Here is the banking sector. We're looking mostly at the big banks. Now recall, the reason that we are watching the banks so closely today is because of SVB Financial. This is the parent company of Silicon Valley Bank. SIVB is the ticker. And the company yesterday saying it took big losses as it was forced to liquidate some Treasury and mortgage-backed security positions. It then initiated a share sale in order to raise capital. CNBC is now reporting that the company's efforts to raise capital have not been successful. It might be putting itself up for sale. The shares are halted. So that's what's going on with SVB, but there are concerns about what's on other bank balance sheets, what is going to be happening as a result of all this. These large banks, analysts are telling us there's not much chance that they're at the same kind of risk. Nonetheless, they are still falling, with the exception of JP Morgan, which is actually trading higher today. And then we are also watching many of the regional banks today. Now, SIVB looks like it's halted, it isn't moving, and that's because the shares are halted pending news. This is what the stock did yesterday. It fell by 60% on all of these concerns. And now as you look today, we're seeing a lot of declines within the other regional banks as well. If I look at the equal weight here, I just want to look at that because I want to highlight in particular First Republic Bank. This is one that is also based in California, and this is also one of the ones where we have seen some of the biggest declines. We have had some halts today because of volatility, not pending news, but because of volatility. But we continue to watch that one close today. So jobs and SVB are kind of the two big stories that we are watching today. On the jobs front, the U.S. labor market, as we've discussed, continues to outperform here, adding over 300,000 new jobs last month in the face of stubborn inflation and aggressive rate hikes from the Fed. For a closer look at the labor picture, we have U.S. Labor Secretary Marty Walsh joining us now. Mr. Secretary, such a pleasure to see you and what's going to be your last time talking to us, at least in this role. And, ending on a pretty strong note when it comes to this report, at least on the headline number. What kind of stood out for you, and what do you, as you look back in your tenure, what's reflected in this jobs report, what are you sort of most proud of that you've been able to achieve there?
Yeah, let me first thank you and everyone at Yahoo for the coverage. This is amazing that you guys do some amazing coverage here. 2 years ago tomorrow, the president passed the American Rescue Plan, and that was to get Americans back to work. You fast forward 2 years later, yet today's job report is 311,000 workers. Every worker, the numbers of prime age workers that were out of work during the pandemic, the beginning of the pandemic, have all returned and recovered. We've seen almost 12.5 million jobs recover to our economy under President Biden's leadership. We're seeing some amazing growth in jobs. We're seeing wages go up. Still, it's ticked down a little bit, but we're still seeing 4.6% year-over-year wage increases. Things are moving in the right direction. The president filed the bill, the budget 2 days ago, and in that budget, he has addressing child care and home care. When you think about labor force participation, we're the highest since pre-pandemic levels. And to even grow that number even further, addressing child care and home care for a lot of people that can't come back to work is going to be important for the future of our economy moving forward. To answer the second part of your question, I'm really proud of the team here at the Department of Labor. They've done some amazing work from all different departments: wage and hour, OSHA, MSHA, workforce development, job training, unemployment. We're doing a reform, have a UI reform office. So there's been a lot of great work here at the Department of Labor on behalf of the American worker and the American people.
Secretary Walsh, our DC producer, Ben Worshkel, went back and watched all 26 of your appearances with us to try to look for some themes. Hopefully you'll check out the piece on the Yahoo Finance platform if you haven't already. One of the priorities that he noted you brought up again and again was the Black unemployment rate, the Latino unemployment rate. And we did see an increase in that rate in this latest jobs report, going up to 5.7% from 5.4%. To what would you attribute that, and what work do you think labor needs to do under your successor in order to try to attack that?
Yeah, and the Latino unemployment rate went up as well this month. It was still at not record lows, but was still low. But two things. Number one is we saw the participation rate in the Latino community go up as well. So that could tell some of the story there. But at the end of the day, the unemployment rate for the Latino community and the Black community has always been historically higher than the white community and the Asian community. And we need to continue to invest in workforce development, job training, apprenticeship programs. And this week here at the Department of Labor, we announced a great partnership between the National Urban League and the National Building Trades to really create pathways into the building trades, working with the Urban League. We need to do more of those partnerships, quite honestly, where you have industries that have really strong apprenticeship programs and organizations like the National Urban League, historic Black organizations, they're going to work to lift people up. And President Biden talks about creating a pathway into industry and building an economy from the bottom up, middle out. He's been very clear to make sure that we're taking care of communities of color and underserved communities, people with disabilities, veterans, rural Americans. We have more work to do. We have to be more intentional about our work.
Secretary Walsh, Ines Ferre here. In speaking to people about this, the issue of if we're going into a recession and if we're seeing tightness in some areas of the labor market still, I mean, could there be a situation where we see a relatively tight labor market in some areas of the economy, but still going into slowdown?
Yeah, it's hard to answer that question. I think that, you know, and I've said this a lot, I'm not an economist. I think that business has figured out how to operate in this world that we're in today. This is not a typical downturn in our economy. This is not like what we've seen in 2008 or 2001 or any other slowdown in the history. This was in large part due to a global pandemic. And I think businesses are figuring that out. Now, I don't think we're going to go into a recession, and I've said it pretty much from day one, because of reports like today and employers still looking for employees and people investing in employees and businesses still growing. So hopefully we'll continue to see that growth. You know, we've seen some areas in this report. We saw some growth in healthcare. We saw growth in professional services. We saw a little decrease in manufacturing. People are like, what does that mean? That means that we're going to watch that number to make sure that it doesn't continue to go on. And the president passed the CHIPS bill, where we're going to be putting manufacturing, tens of thousands of manufacturing jobs online, building microchips in America. That's going to only add to our manufacturing strength here in the United States of America.
And just to follow up, companies are looking for ways to be more efficient. And there's been so much talk about ChatGPT, which I'm sure that you have heard about and talked about with industry leaders. I mean, what are you hearing as far as what this could do to the labor market and what parts of the labor market it could impact?
I'll tell you this, when I talk to employers, and I talk to a lot of employers when I go around the country and here in the office, their biggest number one concern is they don't first say to me about inflation. They don't say to me about potential recession. Their biggest concern is having enough workers skilled in their industry to be able to continue down the road in the future. And that's the biggest number one concern I hear from employers every single day when I talk to them. And I think that that's what we focus on. That's what I'm focusing on in my role here. And I know there's other cabinets that focus on other aspects of business, but I want to make sure we continue, and my successor, Julie Su, will continue to do that as well. Work with business to make sure they have the people they need to be successful businesses and to be able to continue to employ American workers.
And Secretary Walsh, as you look back on your time, I mean, as you talked about, there's a lot you're proud of that you've done at labor. What won't you miss in Washington, or what was sort of the toughest part for you to adjust to in the job?
Do you see that building behind me?
I do see it.
I'm only kidding. No, I'll miss it all. I mean, I've been in public service for 26 years. I've been a legislator in Massachusetts. Obviously, I think when you did your briefing, how many times I mentioned I was the mayor of Boston? Probably 24 out of 26 times. And now as labor secretary. You know, my whole life has been working on behalf of people, and I'm going to miss that. And you know, and there's days when that was tough. And I'm going to miss those days too. I mean, I think when you're in public service, you might have tough days, but you really can't dwell on that. You have to dwell on the ability you have to help change somebody's life. And I hope in my time, at least to this point in my life, that I've been impactful in people's lives, changing their life.
Have you been, you know, coming from Boston, as you have frequently mentioned, I'm curious, you know, more on a national stage, if you have been frustrated by divisions that you've seen in Washington, or have you been surprised that maybe, you know, despite what we see as outsiders, maybe there are fewer divisions than we think, or maybe there are more? I don't know. What do you think as you've been there now for a couple of years?
Let me say this. I think I could say I'm frustrated, but I'm disappointed. When you get elected to office, whether you're a Democrat or Republican, a mayor or not a mayor, as congressman, you represent American people. You represent the people that elected you, but you also represent a greater majority. And my message is simply to Congress and to the Senate is let's start working together. Because the president talks about all the time when he was able to pass legislation, bipartisan legislation, you know, that we celebrated that. When he passed legislation like the American Rescue Plan that wasn't bipartisan, but benefited people in districts, Republican districts all across America. You can't lose sight of why you got elected, and that's my concern. That's a concern I would have moving forward. I've been in hearings up at Capitol Hill, and I've been asked some questions that have nothing to do with a budget. Ridiculous questions. That's not what American people want to hear. They want their legislator to fight on their behalf, not make a political stance on an issue that has nothing to do with the topic in front of us.
I think you probably represent a lot of Americans when you say that. Finally, I want to ask you about your next gig. I know you've been talking about it already. You're going to be executive director of the National Hockey League Players Association. Very different role, but I guess probably has some similarities with what you're doing now. I don't know if you've had a moment to think about your goals as of yet, but I imagine you're pretty excited about it.
No, I am. I've thought a little bit about it. I think of the NHLPA. They've had some leadership in the past that has not been necessarily the best. They've had some consistency there, and I just want to go in and work with the players and talk to the players and do the best job I possibly can do to represent them. It's not just about collective bargaining agreement. It's about making sure the players are treated fairly by the owners and by the league, and making sure that we work collaboratively. I come to this new job. I'll come to this new job the same way I approach every job, collaboratively. I don't like pitting sides against each other. That's not my style. It's something I don't think works. So I'm going to do the best I can to represent the players that put their faith in me to bring me on as their next director.
Do you still play regularly? Just curious.
No, it's been a long time. It's been a long time. This body's getting old, so thank God that one of the job requirements is I don't have to play.
I don't know. I'd love to see you lace on some skates. At least get up there on the ice, even if you don't have to bang into anyone. U.S. Labor Secretary Marty Walsh. It has been such a pleasure to talk to you now 27 times on Yahoo Finance. Appreciate it.
Thank you very much. You guys are great.
Thanks. We got a trending ticker for you right now. Jefferies out with an upgrade on Roblox, the firm bumping up its rating from a hold to a buy based on a favorable narrative that it says is supported by strong net bookings expansion and underlying user metrics. Jefferies expects Roblox to remain among the fastest growing internet companies, earning multiple expansion, higher estimates, and investor interest. The share's not up that much today. There's a lot else going on the macro front, obviously. The title, by the way, of that note, Time to Respect the Community, as in the community that plays. Coming up, we'll do a deeper dive into labor trends with the CEO of Deputy following today's jobs report. That's next. Let's do a quick check of the market sponsored by Tasty Trade. We continue to see stocks trend lower. Actually, I shouldn't say continue because they've been bouncing around this morning in the wake of the jobs report, but have been settling lower now. And of course, as we've been talking about, there are really two big stories we're watching that are the two big stories that are affecting stocks today. One, the jobs report and the implications for the Federal Reserve. Doesn't seem like it changes that much the trajectory of Federal Reserve interest rate increases. And then secondly, the potential meltdown of Silicon Valley Bank. Well, let's get to the jobs part of that equation and to shift workers in particular. Our Australia-based employee management platform Deputy provides companies with employee scheduling, labor compliance tools, and other workforce management services. It's set to release a report with insights from U.S. shift workers across the retail industry. Deputy CEO Silvia Martincevic joins us now to discuss some of those findings. Silvia, thank you for being here. As we look at shift workers and how they fit into the overall workforce, we've watched workers generally really gain power over the course of the pandemic as we've had this tight labor force. Has that been equally true of shift workers, and what does the dynamic look like now?
Good morning, and thank you for having me. You know, what we have seen is that over the last decade, Julie, knowledge workers like you and I, they have seen massive improvements in productivity. We have tools like Slack and Zoom and Asana and many others. And shift workers don't have access necessarily to those tools, and because they're on the move. And so what Deputy is trying to do is to solve this problem for shift workers with productivity tools at their fingertips. And so what we're seeing is that shift workers, especially women, really need that flexibility. And some of the tools that we provide is automates that scheduling where you could swap your shifts if you need to, if you have childcare problems. We also have seen that the engagement of shift workers, just like engagement for all of the workers, has declined. And so, you know, for shift workers who are always on the move, we provide daily engagement scores so that at the end of their shifts, employers can know how their workers are feeling to make sure that they retain them.
Silvia, Ines here, and you have a retail report or data analysis that you'll be releasing about the retail industry. So can you give us a little bit of insight as to what you're seeing in that industry?
Absolutely. So we collect billions of rows of data on shift work, on engagement, and that allows us really to see workforce trends before they even materialize. And so there were three things really that stood out in this year's shift report related to older workers, related to younger growth cities, and related to women. So first, on the older workers, we're seeing that older workers, baby boomers, they're increasingly re-entering workforce. Some of them went into early retirement during the pandemic, and given the current financial climate, they're re-entering workforce. We saw that percentage of baby boomers in the shift workforce grow from 20 to 23%. We have also seen this emergence of young growth cities like Austin, Nashville, Vegas, and they're truly leading the retail employment. And we expect that these young growth cities are going to lead in economic recovery across most sectors. And three, and a very important topic, is women. We have seen that we have lost over 1 million women since February of 2020 in US labor force. And, you know, we think that pandemic exposed many difficulties that labor secretary spoke about, which is for women, which is accessing childcare. And so we certainly hope that through software, as well as through some of the movements that have started in some states, like Fair Work Week, we hope that that's a catalyst for helping women re-enter the workforce.
And Silvia, you mentioned baby boomers re-entering the workforce. I mean, if you just take a look at today's jobs report for February, an increase of 311,000 jobs. You have the unemployment that ticked up to 3.6%. You have wages that increased not as much as expected. And the thesis that some have is that people are holding two jobs. Perhaps people are getting two jobs because of inflation. Are you seeing that in your data?
We absolutely are. In fact, we are also seeing that shift workers are changing jobs. On average, we're seeing that a shift worker holds a job for about 8 months or so. And so, for employers out there of these workers, it's unbelievably important that we improve conditions, that we provide flexibility, that we have, some of these engagement tools, that we communicate much better. In tight labor markets, it is incredibly important to create happier workplaces for the most vulnerable workers, which are 2/3 of the world's workforce, which are shift workers.
Sylvia, really interesting stuff, and a sector of the labor market that we don't talk enough about. So we appreciate your insight. Deputy CEO Sylvia Martincevic, thank you so much. Wanted to bring you an update on the SVB situation, Silicon Valley Bank, the parent company, SVB Financial. We had apparently Treasury Secretary Janet Yellen comment on this situation now. She must have been asked a question about it. And she said, indeed, that the Treasury Department is monitoring the situation. She says, in particular, Treasury is monitoring, quote, a few banks amid issues at SVB. If you recall, the issue at SVB, the company seemed to have needed to raise capital, did so by selling treasuries and mortgage-backed securities at a loss because of the rise that we have seen in interest rates. So now the question is, will we see other banks have similar issues? So this is something we continue to watch. Here's a look at the regional banks. SIVB in your upper left corner is still halted. That's why you don't see any change. But you see some of the other regional banks that have really been affected, particularly the West Coast banks that are potentially exposed to the venture capital industry. PacWest Bancorp, just one example, down 40% over the past 2 days.
And First Republic Bank also halted after SVB also was halted. And so you're looking at First Republic that's halted for trading. You're also looking at SVB that's still halted. And also Reuters now reporting that SVB has told its staff to work from home.
Yeah, and just to make the distinction here, SVB halted pending news. First Republic halted, I believe, because of volatility, because it triggered the volatility limits there in trading, which is something that can happen when you see big swings in stocks. Coming up, JP Morgan is suing a former executive over his alleged ties to Jeffrey Epstein. We'll explain that next.
A New York judge has ordered JP Morgan to turn over more records of its CEO, Jamie Dimon, in a lawsuit by the U.S. Virgin Islands. The island's government says the bank helped aid the late Jeffrey Epstein's sex trafficking operation by keeping him as a client. The order comes on the heels of court filings by JP Morgan that instead say the bank's former executive, Jess Staley, is to blame for the bank's Epstein ties. Yahoo Finance's Alexis Keenan is here to join us now and to break it all down for us.
Yeah, so this is one of two cases that JP Morgan is defending in federal court in New York. Both of them allege that in some capacity, the bank aided Epstein's ability to continue this, the late Epstein, I should say, his sex trafficking operation that went on for decades. Now, the plaintiffs say that JP Morgan should have identified evidence of this wrongdoing by Epstein and that the bank also benefited from the client relationship that they had with him. Now, yesterday, a case brought by the U.S. Virgin Islands government. In that case, the judge ordered JP Morgan to turn over more documents belonging to CEO Jamie Dimon. And what's puzzling or interesting about that order is that the time frame for these documents, they're after the time that JP Morgan had already canceled Epstein as a client. They had already given up on him. And that time frame is from 2015 to 2019, whereas Epstein was a client of the bank from 2000 to 2013. Now, the other case, it's brought by a woman who is identified in a purported class action as Jane Doe #1. She alleges that she was abused by Epstein. Now, all of this, though, comes right after earlier in the week, JP Morgan goes on the offensive and files in both of these cases a third-party complaint saying, no, it's not us, it's not the bank that is responsible, if there's any responsibility in these cases at all, but instead it's our former wealth manager, Jess Staley, who was an employee of the bank for some time. Now, JP Morgan is saying in these two complaints that they are entitled to reimbursement if there is a judgment or damages entered in either of these cases. In its complaint, the bank says it denies all liability. It says at no point did Staley disclose to JP Morgan, nor did JP Morgan know about Staley's personal activities. In a statement to Yahoo Finance, the bank goes on to say that the plaintiffs have made absolutely troubling allegations concerning Staley. And if those are true, right, we don't know if they're true, these are just allegations at this point, that he should be held responsible. At the time, the bank says we could not have imagined any of our employees would engage in the type of conduct alleged.
Personal conduct is one thing. If there was some sort of financial relationship between the two men, that is another. I mean, and I think this speaks to not just the issue at the bank, but a bigger issue in corporate America, which is oversight of employees, particularly high-level employees like Staley was at JP Morgan. And I don't know if this case sort of has implications broader than that, depending on how it goes.
Yeah, I mean, I think we could hypothesize that perhaps there's less oversight when they're high-level employees at a company. I think certainly these days we all expect that there's some level of monitoring of our communications and what we do at work. And look, there is vicarious liability. It's a concept in law where an employer can be held responsible for the acts of the employee, but that's when the acts of the employee are within the scope of that employee's work. It has to be within the scope of their job. And what JP Morgan is saying here is that the conduct that they're alleging, that the plaintiffs are alleging Staley engaged in, they say, well, if that happened, that was far outside the scope of his work, and therefore he would be the one to blame, not us.
It's going to be really interesting to see how this one goes. Thank you so much, Alexis. Appreciate it. Let's get to geopolitics now, because there is an important development. Saudi Arabia and Iran have reached an agreement to revive diplomatic ties. That's during talks brokered by Chinese officials in Beijing. The deal ends 7 years of estrangement between the two regional rivals. For more on this, we're joined now by Rick Newman. So, Rick, what are the implications of this? Why is this so important?
It's a big deal. I mean, the Middle East is a troubled region. This suggests it might be a little more peaceable in coming years. These two nations that stare at each other across the Persian Gulf, or the Arabian Gulf, as they call it in the region, have been bitter enemies. And Iran even attacked some Saudi oil infrastructure with drones a couple of years back. So it would really settle things down between these two countries if this peace deal holds. One important thing here is the United States has nothing to do with this. I mean, the United States has long been the most dominant outside power in the Middle East. But guess who brokered this deal? China. The deal was made in Beijing, and that is really important. China is becoming a much more assertive power in the Middle East. It needs the energy from Saudi Arabia and from Iran, and has pretty strong ties with both of those countries on that basis. In fact, China is now Saudi Arabia's biggest customer. That used to be the United States, and now it's China. That's in a way a good thing for us because we're producing a lot more of our own oil and other types of energy now. But China clearly more assertive in the Middle East, and this deal that they brokered demonstrates it. This also gets into relations with Israel, and there are a lot of question marks. So we will be watching this for many months to see if it sticks and what it really changes, but it's important.
Yeah, I was going to ask about the Israel angle in particular as well, right? Because there have been some signs of rapprochement between Israel and some other countries in the region, certainly not with Iran, however. And right. Israel is undergoing enormous internal turmoil right now. So does this then kind of reset the balance in the region?
I mean, that would be great, but I think there have been so many dashed hopes about peace breaking out in the Middle East that it's prudent to be very skeptical. So Iran, there's nothing in this deal that suggests Iran will change its extremely hostile policy toward Israel. And of course, Israel has been doing everything it can to prevent Iran from getting nuclear weapons that it can put on top of a ballistic missile and in theory fire at Israel someday. So Iran still supports anti-Israel militias all throughout the Middle East, and there's no indication that is likely to change. So better that Saudi Arabia and Iran get along than that they don't get along, but I'm not sure peace is going to break out in the Middle East.
Yeah, I don't think we should cross our fingers on that one. Thank you so much, Rick. Really appreciate it.
Yep. Bye, guys.
Coming up, why the Oscars may have a different feel this year. Ali Canal's got the latest next. Oscars night in Hollywood is almost here. This weekend, actors, directors, and producers come together to celebrate the art of filmmaking. Meanwhile, movie studios and streaming companies will be looking to count up awards from nominees like Everything Everywhere All at Once and The Banshees of Inisherin. Still, traditional studios appear to have a slight edge. Yahoo Finance's Alexander Canal has the details.
The 2023 Oscars is looking a bit different this year as streaming giants come up short and the focus shifts once again to traditional Hollywood studios. Here's how we got here and why the decline in streaming nominations might not be as dire as it looks. Streamers garnered about half the amount of nominations in 2023 compared to 2022, with the big three, Netflix, Apple, and Amazon, receiving just 19 nods in total versus last year's 37. Netflix was the most nominated of the bunch with 16 total nods, followed by Apple with 2 and Amazon with just 1. Keep in mind, Apple actually walked away with Best Picture in 2022 thanks to Coda. At the time, the win was categorized as a huge breakthrough moment for streamers, and it seems like finally the lines between traditional film studios and streaming exclusives had been blurred. But it seems like the Academy isn't giving in that easily. In fact, streamers were completely shut out of popular categories this year like Best Director. Remember, Jane Campion won in 2022 for Netflix's Power of the Dog. Not only that, but the number of nominations has been on a steady downward trend in recent years. Still, there's one big question to ask. Does this all matter? Oscar viewership has struggled, especially as the top moments usually end up on Twitter or YouTube relatively quickly. According to Nielsen, 2022's Academy Awards drew in 16.6 million viewers. That was actually up 58% from 2021's record low of 10.5 million, but still the second worst viewership number in the show's 94-year history. And let's take a movie like Knives Out, Glass Onion, for example. Only one Oscar nomination for Best Adapted Screenplay, but still the fourth most watched Netflix original of all time, with nearly 280 million hours viewed in its first 28 days on the platform. That's a pretty strong showing for a film not rolling in nominations.
Well, this is truly delightful.
Or what about Top Gun Maverick, Avatar: The Way of Water, two of the highest grossing films in 2022, and yet nominated just 2 and 4 times respectively?
Just want to manage expectations.
You see, before streaming, there were obvious boosts in box office receipts after a film was nominated or won an Oscar. But with all the changes in media, it's hard to really judge the quote-unquote payout of an Oscar win, especially for streamers, which care most about subscribers. So even though streaming platforms may not be enjoying the same level of Oscar attention as they received in the past, it doesn't mean they don't have just as much, if not more, visibility, with hundreds of millions of paying users at their fingertips. That being said, the Oscars is the biggest award show stage of them all, with many industry watchers adamant that Academy Award wins and nominations do still matter. It just might not matter as much to the streamers, which are way more focused on subscribers and profitability than Oscar statuettes.
Allie's with us here on set. Are people still invested in the Oscars, though? Or, speaking about everyday viewers, that is?
Yeah, and that's a big question. And like we saw in that package, the Oscar viewership, that's been on a steady decline. The production team, they've tried different types of strategies to try and lure in viewers. We've had no hosts. Last year, we had 3 hosts. This year, Jimmy Kimmel is coming back. But I do think there seems to be a disconnect between the everyday viewer and then, the Academy, right? And I think, especially if you look at the types of movies that have been nominated in the past, those big budget blockbuster movies, those films that have garnered billions and billions of dollars at the box office, they're not necessarily getting that same recognition. One that comes to mind to me is Spider-Man: No Way Home in 2021. This was really the first big film that was back since the pandemic. It grossed nearly $2 billion globally, and yet it only received 1 nomination for visual effects, none for Best Picture. This year it's a bit different since we do have Top Gun Maverick and Avatar: The Way of Water nominated for Best Picture. I don't think they'll win, but still a step there. And we did hear from IMAX CEO Richard Gelfond. He was on the show earlier this week talking about this shift to potentially seeing more blockbusters in that nomination pool. Here's what he had to say.
Hollywood a little bit lost its way with the Oscars, and I think it was a little too much inside baseball and it was a little too much streaming movies. This year's movies are a lot more like old-fashioned movies, big special effects, big stars, big cultural events, global events in the world. And I think if the Oscars want to remain relevant, they needed to move back to that direction. I think it's great they're doing it.
So we'll see if this is a one-off trend, if this is something that will continue. Again, I don't think those movies will win. I think it's going to go to Everywhere, Everything All at Once. That has been the award show darling this season. I think it's their win to lose. So we'll see. I don't know. Have you guys watched any of these movies? Are you excited for the Oscars?
I have not had time to watch any movies, but I know you will be watching the Oscars.
Yeah, I definitely will not
And
be
you are
watching
going to give us the lowdown.
Yes, that's
Julie's a Twitter next day. Well, yes.
I go to bed.
That's a lot of people. It's late. I know. It's
I can't wait
3.5 hours.
And
long.
also, I too have not seen any of these movies, but I will at some point in the future.
Exactly. And maybe whoever wins, maybe that'll.
I've been wanting to see Everything Everywhere all along.
You'll tell us which ones to watch.
Absolutely.
Thank you. Coming up, could training for your next job take place in the metaverse? We'll talk VR's use for training new employees with the CEO of training simulation company Striver. Stay tuned. The metaverse goes corporate. Striver, which creates virtual reality training simulations, hopes it can help retail and hospitality companies strike a balance between profitability demands, employee training costs, and staff retention, despite a historically strong jobs market. Joining us with more, Derek Belch, Striver CEO. Derek, thanks so much for joining us. So for a lot of people, this concept may be new. A VR set for corporate training. Talk us through it for a second. I mean, give us an example of what this entails.
Sure. Basically, morning, Inez. Thank you. Long story short, virtual reality is like a pilot going through a flight simulator. Flight simulators have been used for a long, long time. They're very effective. They historically cost tens of millions of dollars. And to bring this to light, I always like to talk with a prop, right? Here you go. Here's a VR headset right here. This thing costs a couple $100. You put it on your face and boom, you are in a virtual world. You're in a simulation. that puts you in the shoes of what you would be doing, thinking, feeling in your everyday job, from a janitor to a CEO and everything in between. That's basically the premise of what we're doing here.
And so who are some of your clients? Who are the people who are interested in this kind of training right now?
Yeah, so we're one of the bigger, longer tenured startups in this space. This is our 9th year in business. We started actually in the NFL and college football, training quarterbacks years ago, and then we pivoted to the enterprise 6 years ago, and we were very fortunate that Walmart was our very first customer. Fortune 1 was our first customer, which is pretty rare. And the years since, we've added Verizon, FedEx, Bank of America, Sprouts, Advent Health. The list goes on and on. We have a pretty good chunk of the Fortune 10 and Fortune 100 at this point. We're very fortunate.
Today we got the jobs report, and 311,000 jobs were added. Several sectors added jobs, a couple contracted. Are you seeing anything when it comes to your clients as far as these companies are concerned? Which ones are the ones that are offering training? Which ones are the ones that are hiring? What sectors or what types of jobs are you seeing?
Sure. So, the sweet spot for us right now, and I think really VR as a whole, is really where a frontline worker type is the end user. Obviously, I just listed a bunch of companies where that's a fit, right? I think the operational use case is a very strong one, and there's kind of this spectrum of decision making, situational awareness, all the way to what I'm doing and with my hands in some sort of step-by-step process, right? And then the long tail of all of this will be more of that knowledge worker, kind of soft skills managerial use case. We're starting to see a bit of that, probably, still a few years away. But, that frontline worker as the end user is the really strong use case right now for the majority of our customers.
And I'd imagine with some of this training, the companies can get data on what the actual person that's training doing. I mean, sometimes you can check out during training, but not here.
No one's ever fallen asleep in a headset, Inez. I mean, that's the reality here, right? And even back to our sports days, right? When we were mainly working with quarterbacks, most people don't know this, but even Tom Brady falls asleep in film sessions, right? I mean, it happens. And we've all been in those moments where we're just clicking through a PowerPoint or we're watching a video. We're not really paying attention. The information goes in one ear and out the other. So really the crux of what we're doing here is it's like attention and visualization on steroids. And then going back to that flight simulator metaphor, when the employee is in the headset, we get a pretty good idea of how they're going to think, feel, behave, act in the real world. I mean, it's not quite a one-to-one correlation, but it's pretty dang close. So as we think about the future of training and simulation and onboarding, and maybe even hiring for that matter, getting a very realistic preview of how that employee is going to perform in the real world in an objective, unbiased manner, I mean, that's the holy grail that all these companies are looking for, right? So
it is the holy grail, but I got to ask you, Derek, are they willing to pay for the holy grail? We're in this environment where belt tightening is the name of the game. And I don't know how much these programs and this hardware runs companies, but are you seeing any kind of chipping away at demand?
Sure. This must be a business show because this is the question, right? I mean, we're still in startup mode 9 years later, but we're doing quite well. But yeah, I mean, Julie, you hit the nail on the head. So far, yes, they are, and the ROI equations, candidly, are pretty simple. Most of it comes down to time savings and therefore cost savings. We've had a lot of customers literally show us their equations. Hey, my onboarding time used to be 12 weeks, used to be 6 weeks. I cut it in half. Right? People are learning the same amount of information or more in a fraction of the time. So those ROI equations are pretty cut and dry from both a hard dollars and then a soft dollars perspective. As it relates to the cost that you referenced, on the low end today, you can get a really awesome VR device for $500. On the high end, maybe $2,000, $3,000, $4,000. We'll see what happens when Apple releases its device, and hopefully in a few months. That's been rumored to be a couple $1,000s out of the gate, but we'll see. Then you got to build your content, right? So there are costs involved, but we are in what I like to call the cheaper, lighter, faster era of virtual reality. Now, are we in the top of the second or the bottom of the sixth? Who knows? Probably more like the former. But this is not as cost prohibitive as people would think, especially when you build a really tight ROI equation, which we've done with all of our customers.
Interesting. Derek, thank you so much. I hope you have a good weekend, and you can add another golf ball to your wall, maybe, playing this weekend.
I'm going to Australia this weekend, and there will be a few that go on that wall. So
Nice.
Thank you, Julie. I appreciate it.
Derek Belch, Driver CEO. Appreciate it. Coming up, we've got some big interviews on tap. We'll tell you what to watch next. That does it for Ines and I today. But in the next hour, we'll continue our coverage of the February jobs report. That's not all, though. Tomorrow is the 3-year anniversary of the start of the COVID-19 pandemic. And we're going to take a look back on the pandemic's impact on business and discuss what's ahead with Kearney's Greg Portell.
And the state of shopping. We'll discuss retail and e-commerce and how Walmart is leveling up with Amazon with Cowen analyst Oliver Chen.
Plus, the Oscars are taking center stage this weekend. We'll give you all the numbers and discuss outlook for streaming with Macquarie's Chad Bynan. We've got all this and more. Jared Bluke is going to get you for the next hour trading, and he, of course, will continue to be watching the unfolding situation with Silicon Valley Bank and its parent, SVB Financial. If we take a look at the heat map of the regional banks, we continue to see them under pressure here, and SVB itself remains halted pending news. There have been reports that the company did not succeed in raising capital and might be putting itself up for sale. We'll keep watching it. Keep it right here.
Hello and welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery in for Rochelle Akufo, and here's what I'm watching today. U.S. jobs market is not cooling off. U.S. economy adding 311,000 jobs in February, well above the 215,000 estimate, but is slowing wage growth, the silver lining. Silicon Valley Bank shares are halted as reports suggest it's looking for a buyer. How deep does a banking contagion go, and what's the Fed's role in all of this? We explain. And Treasury Secretary Janet Yellen calls on Congress to increase the federal debt limit in order to avoid what she calls a, quote, catastrophe. We're across that story. But first, the major indices are mixed. It looks like the Dow's still in the green, but just for a few points. They're about less than 50. And looks like the Nasdaq is down about 1/3% to 0.5%. And let's check in on the Treasury market. 10-year yield falling sharply down to about 3.7%. By the way, that is the biggest two-day slide in the 10-year that we have had since about November. Now, we want to get right to our main story. That's Janet Yellen and her testimony in front of the Ways and Means Committee. This has to do with her testimony today. And of course, we want to get some comments from our Yahoo Finance's Jen Schonberger. So Jennifer, tell us what you're covering today.
Good morning, Jared. Treasury Secretary Janet Yellen says there are a few banks the department is closely monitoring after Silicon Valley Bank failed to raise fresh cash. Worries at SVB sparking fears that other banks could be forced to take losses and raise cash. Take a listen to the secretary.
There are recent developments that concern a few banks that I'm monitoring very carefully, and when banks experience financial losses, it is and should be a matter of concern.
Yellen, who is testifying this morning before the Republican House Ways and Means Committee on President Biden's 2024 proposed budget, also warned about failure to raise the debt ceiling, saying that could cause an economic calamity. Take a listen.
Since 1789, the United States has always paid its bills on time, and it must continue to do so. In my assessment and those of economists across the board, a default on our debt would trigger an economic and financial catastrophe. I urge all members of Congress to come together to address the debt limit without conditions and without waiting until the last minute.
Now, just moments ago, Yellen saying that debt prioritization is not a solution for raising the debt limit, calling that default by another name. Now, House Republicans have threatened not to raise the debt ceiling without federal spending cuts. The Treasury currently employing extraordinary measures to keep paying the U.S.'s bills, though those measures expected to run out by June. Now, Yellen also addressed the February jobs report, characterizing the job market as strong and noting the uptick in the labor participation rate. She said that with more people coming into the labor force, that could help address the supply and demand imbalance that the Fed is closely watching. Separately, Republicans on the committee took the hearings forum to grill the Treasury Secretary on increased funding for the IRS and concerns that uses for the funding are opaque and that the funding used to increase audits on wealthy Americans and corporations would actually be used for everyday Americans. Yellen repeatedly reassured lawmakers that the president has pledged not to increase audits on small businesses and even individuals earning more than $400,000 a year. Jared?
Lots to keep track of today, and we're glad you're on that, Jennifer Schonberger. All right, well, let's stick with the jobs theme. A strong February jobs report worrying more than just the Treasury Secretary as employers try to navigate a changing jobs landscape. Here with some insight into the jobs market, Nick Bunker, Research Director at the Indeed Hiring Lab. Nick, glad you could be with us today. Your first blush, take on the jobs report this morning, as we've been talking about throughout our live shows today. Something in there for everybody, both the Bulls and the Bears, the Hawks and the Doves. What's your big takeaway?
So I think there's two main through lines for me. One is that this is an incredibly resilient labor market and one that's adding jobs at a really, really strong pace. But at the same time, there are some signs that we're on a path to a more sustainable but strong pace of growth. The labor force participation rate, particularly for prime age workers, picked up and now is back at where we were in early 2020. And there are signs that wage gains continue to moderate. So demand is still strong, joblessness is low, and it looks like we are on a path towards getting to something that's more sustainable. But the question is, how long are we going to take to walk down that path?
Yeah, and we saw it's been a really big week in the Treasury market. We saw Jay Powell get hawkish in front of Congress, and now it looks like this latest report, because there is some weakness despite the overall strength. Some people are saying this gives the Fed the cover to only raise by 25 basis points. By the way, that was exactly what people were expecting on Tuesday morning before Powell came in. What do you think happens with the Fed in a week?
So I think, if you look at this jobs report, there are some encouraging signs within the Fed's framework that there is, moderating wage growth, which, Chair Powell in the past has really sort of mentioned as the best barometer of the labor market. I think really the question is, does the Fed take some solace from, signs that realized wage growth is ticking down, or does it start to be, continue to be concerned by the high level of payroll gains and the low level of unemployment? So I do think it matters sort of where the points of emphasis are there, though, whether or not we get 25 or 50 basis points the next meeting, I think there's clearly a hawkish tilt towards the Fed's commentary.
All right, I want to get to another labor report that came out recently. That would be the JOLTS report, job openings, layoffs, turnovers. Just want to get your take here. I'm reading through your notes. The data on quitting is the most suggestive of a moderating labor market. Wondering if this morning's news on the payroll numbers from the BLS changed your thinking on that, or where are you there?
Yeah, so I think the data we got today is in line with that. I think there's a pretty strong relationship between the rate at which people are quitting their jobs or voluntarily leaving their old jobs, most likely to head to new ones, and wage gains. And in both of those metrics, we are starting to see signs of moderation, even if they're both still elevated compared to their pre-pandemic level. So if we continue to see workers, quit their jobs at lower rates, that would suggest that wage growth has some ways to go down. But at the same time, it's still probably at a pace higher than what we saw before the pandemic. So I think broadly, my view of the labor market continues to be the same, that there's lots of strength, even if there's been moderation over the past several months.
And as typical in this stage of the business cycle, we're seeing goods, and I'm still talking about the labor market in the BLS report this morning. We're seeing goods producing industry shed jobs. The service industry still rolling strong here. Just roll out some statistics. Let me get to the leisure and hospitality. They added 105,000 jobs. You can see that second to the left there. Retail up 50,000. Even construction, which usually leads jobs during downturns, that's up 24,000. That's not a service job. What do you make of some of the detail in these various industries here?
So I think one thing, like you just said, the fact that construction continues to add jobs is not only surprising given the recessionary concerns, but really a sort of surprising source of strength given what's happened to mortgage rates over the past year or so, which I think suggests that there's a continued backlog of construction, be it both in the residential space, but also potentially with a lot of the infrastructure spending that's coming online that continues to power demand for workers in that sector. And you just mentioned the leisure and hospitality numbers. Yeah. That's been a real continued source of strength for the labor market. And as that sector continues to rebound from that big, massive shock from the beginning of the pandemic, as workers return to that sector and employment wraps up, that's one reason why we continue to see strong headline gains in the overall U.S. labor market.
And we got time for another one here. Just want to let me give you the floor. As you're going through talking to clients about the labor market, any kind of pockets of strength or weaknesses that are really standing out to you? We've seen all these tech layoffs. They haven't necessarily shown up in the aggregate statistics. I'm just wondering where you're seeing that fall.
Yeah, so I think what we can see in Indeed data is very clear that demand for a lot of the jobs associated with technology firms are really pulling back. Software development jobs on a year-over-year basis, the number of job postings there is down close to 40%. So there's clearly been a dramatic pullback in that sector of the labor market. But as you said, we really can't see even these announced layoffs show up necessarily in the aggregate statistics. I think that's a good reminder, a good indicator that the tech sector is a big part of our discussion about the economy, a big part of financial markets, but it's not a huge share of employment. In fact, it's quite small. So I think there's clearly some sectors going through periods of pain and retrenchment right now, notably the tech sector. but that's not indicative of what we're seeing at the overall U.S. labor market.
And finally, by the way, I lied a minute ago. We have time for two more, or had time for two more. This is the last one. SVB Bank really in sights this morning because the shares are halted. They're looking for a buyer of the bank. It looks like FDIC most likely involved. And this is a specialty bank that really serves the California VC economy and kind of melds with the discussion we were just having via the tech market that is very specialized. And we're not really seeing contagion overall in the market yet, but just wondering what your overall impression is as it pertains to SVB this morning.
Yeah, so I think I will fully admit this is not something I track very closely, but you know, the hope is that it's contained, and I will definitely be tracking the news myself just to see, hopefully, that no contagion.
All right.
Beyond that.
Don't mean to put you on the spot there, but appreciate all your insights this morning. Nick Bunker, Research Director at the Indeed Hiring Lab. Thank you. Coming up, Silicon Valley Bank shares, we're just talking about those, they plummeted this week. We explore the effect it's having on global equity markets and how it ties into Fed policy. Up next. Welcome back. Concerns over the stability of financial systems back in focus. Shares of Silicon Valley Bank, also known as SVB, nosedove yesterday, causing a ripple effect for the global equity markets. They're now halted, and CNBC is reporting it may be looking for a sale. And while Reuters reports employees have been asked to work from home, now Fed policy, of course, playing a big role in all of this, but exactly how? That's a key question. And Yahoo Finance's Julie Hyman can help explain. Julie, help explain.
I'm going to try here
Okay.
to explain how rates are playing a role in all of this. Basically, it has to do with the assets that SVB held on its balance sheet. Apparently, the company was forced to sell Treasury bonds as well as mortgage-backed securities. It sold them, reportedly, according to what we're kind of teasing out from the situation, because it needed to raise capital, because its clients, venture funds, startups, etc., were withdrawing money. The company needed to raise money, and so did a sale. It did a sale at a loss. And what is the Fed's impact on those assets that it held on its balance sheet, like treasuries? Well, of course, bonds are very sensitive to interest rate changes. The Fed has been raising interest rates. The market price of existing bonds drops, and the yields go higher, and then new bonds come on the market on higher rates. Banks are not required to write down the value of these types of assets on their balance sheet until they sell them. And so large banks, for example, which tend to be better capitalized and don't have as many withdrawals that they need to then raise money, they're in a better position. They don't need to write down the value of these kinds of assets. There are a lot of bonds on bank balance sheets broadly, $2.2 trillion. That's according to the Wall Street Journal, which cited data from Fed filings here. And so that's why you're seeing this concern in the market right now. Again, when banks sell these bonds, they recognize them as losses on their balance sheets, but only when they sell them. SVB was forced to sell about $21 billion worth of Treasury securities at substantial losses. And then SVB said it was issuing shares to raise money and cover those losses. And that's what raised alarm bells across the investment space. Here is a look at growth in unrealized losses. This data dating to September 2022. If these banks hold these treasuries until maturity, there's not necessarily this issue, because then they collect the full coupon and they don't have losses. At least that's my understanding. Jared Buckley, if I have that part right, correct me if I'm wrong.
Do they collect the coupon? I mean,
in other words, the reason that they had to mark these down is because they sold them before maturity.
Oh, yes.
If you hold them to maturity, I don't think there's the same kind of write-down, even because there's no write-down to present value, right?
Exactly. So if you think about it this way, a bank has on its balance sheet assets and liabilities, and the assets are what it's loaning out to other people. So if somebody owes money to the bank, that's an asset. If the bank owes money to somebody else, that is a liability. So let's say you have depositors here. Depositors withdrawing their money, there's not as much money there, so the bank has to sell money, or has to sell some of its bonds, like Treasury coupons and Treasury securities, in order to fund that. Well, if they need to raise that money and the value of those bonds have gone down, they realize those capital losses. Had they held those to maturity, as you're saying, Julie, would have been no problem there. But this gets back to Treasury market volatility, and this is something that reared its head in the late 70s and the early 80s while Volcker was at the Fed and then Greenspan. This is something that banks had to deal with back then, and it's been almost 40 years since then. And so we don't really have a regulatory structure that's in place that allows us to deal with these kinds of things.
Right.
So as I was saying a few hours ago, this seems to me like a kind of a slow motion train wreck. We're probably going to see these little pockets of instability, but not necessarily systemic risk.
No, not necessarily systemic, because we know a lot of these banks loaded up on these kinds of securities over the past few years, but most of them most likely are not going to be forced to sell them.
Yeah, I would agree there. It looks like, and the Fed has a lot of wiggle room. We're talking about, are they going to go to 25 to 50 basis points? But we'll see how this unfolds here. All right. Thank you for that, by the way, Julie Hyman. Checking in on the markets here, sponsored by Tasty Trade. We are looking at what was a mixed market, still mixed market. It looks like the Dow still holding gains, but just barely of 7 basis points. S&P 500 down 22 basis points, about 0.25%. Nasdaq down just slightly. All right, we're going to take a deeper look at the markets up next and what sectors you should be pouncing on when we come back. Welcome back to Yahoo Finance Live. It's been a wild week on Wall Street following Jerome Powell's hawkish tone on inflation and, of course, today's jobs report. Joining us to help make sense of what it means for markets and what investors should do next, Ameriprise Financial Private Wealth Advisor and CEO of O+, Advice First, Nancy Dowd. So, Nancy, let me ask you, first blush impression of this morning's payroll report, some good, some bad potentially, and what does it mean for markets?
Well, it was probably a little bit better than what's expected, but not much. So I don't know that there will be that much of an impact. Everything is pretty much as expected. These are usually lagging indicators, so we're not going to see the job market numbers really change dramatically until several months later. So although we're hearing about layoffs and changes, that doesn't really get posted in the data until significantly later. But apparently women are going back into the job markets in droves, so that's creating a little bit of more activity than normal.
Well, let's talk about that. If we got a second, can you delve into some of those statistics that you just mentioned, women re-entering the workforce in droves? What's supporting that?
Well, they had pulled back. There was a significant pullback in both men and women during COVID. And although the male population went back to work fairly quickly, the female population lagged a little bit, and now that's catching up. So that's probably affecting some of those numbers, but who knows?
Yeah, who knows? We deal with aggregates here, and sometimes it's difficult to read into them. We saw a rise in temporary workers this morning, and I'm just wondering if that means anything to you with respect to minimum wage standards. Sometimes, and this is just one theory I've seen floated, that companies realizing that there is, or potentially a big economic downturn, or even a small one, they're trimming their books. They're getting rid of full-timers and maybe loading up on some of those temp workers. Just wondering if there's anything or any kind of narrative you're seeing there that's emerging from the data.
Well, it's all, a little bit from each aspect. The inflation is going to eat away at every aspect of business. So, when California raises the minimum wage to $15 per hour, how many more states are going to follow suit, and what effect will that have? These are all just one more line item that is sort of the product of the inflation that we're experiencing. And it's just all falling into place. We're seeing it finally happening.
Yes, and we saw the wealth gap actually expand quite a bit over the last 15 years. Most of that time we had very low prevailing interest rates, but now we're seeing interest rates rise along with inflation. And I'm just wondering how this fits into what you're seeing happen with fiscal policy, trying to close that wealth gap. Any silver lining there with respect to maybe higher interest rates once we get over this inflation hump are going to actually help close the wealth gap?
Well, I'm not sure that we're going to be able to close the wealth gap anytime soon. That, like I said, it depends on how many other states follow suit and how corporations respond to the inflationary pressures. But we are seeing corporate profits decline. We are seeing debt costs rising. So that's certainly going to affect markets. And these are all things that are expected in order to get to the other side of the inflation number, which Mr. Powell has been very adamant about. He's been quite consistent about, well, we're going to just keep raising rates until we get there. So we are somewhat beginning to see that happen now. The reality is finally occurring, and it's painful. And it's going to be painful for a few more months. Probably not until the later part of this year or into early 2024.
And so what would
for investors,
yes, that was my next question. What should investors do?
Well, so what we're telling our clients is we've got to stay the course. We keep taking a survey of each person's appetite for risk again. We're testing their stomach lining, as I call it. Are you okay with where you are? Because this is going to last a little bit longer. How do you feel? And I think that's a really good measure to keep asking yourself, am I okay with what's going on? Because bear markets, just like bull markets, do end eventually, and this too will pass. But we just have to be a lot more patient.
Yep, this too will pass, and we thank you for your insights here. Nancy Daoud, American Financial Private Wealth Advisor and CEO of O+. Coming up, Saturday marks the 3-year anniversary of the coronavirus pandemic. We take a look at what has changed and what hasn't when we come back. Welcome back. As we approach March 11th, the 3rd anniversary of the COVID-19 pandemic, we've seen businesses pivot in new ways to take advantage of opportunities and reduce risk caused by the pandemic. Companies have adopted hybrid workforces, tackled surging demand, and taken advantage of home delivery. And joining us now to discuss how those pandemic winners and losers is Kearney lead partner Greg Portell, joined by Yahoo Finance's Anjali Kemlani. Thank you for joining us here today. Let me just start. We saw a number of trends emerge over the pandemic. Some of them were walked back. Some of them are still with us. Just what's your big picture view of how things have evolved?
Well, obviously, when you have a disruption like a pandemic, you have an enormous change in behavior right away. And that does create that artificial demand and artificial behavior shift that then obviously needs to come back. So I think you found that people are much more comfortable working in virtual environments. And that is something that we probably wouldn't have experienced or gotten to this quickly without that kind of shock like a pandemic.
Greg, Anjali here. I wonder about that because we saw it play out pretty differently for different companies and different sectors. But we know that broadly speaking, one of the biggest impacts has been on small businesses. So curious to know your thoughts on how that plays out moving forward. Do we have maybe a reversal? Is, pre-2020 coming back anytime soon? And are we in really truly a new long-standing phase here where local restaurants and the like just don't have a path forward?
Well, what's interesting is prior to the pandemic, we saw consumers in particular really embrace local and community. That's when you saw beer pubs, for example, were really starting to pop up. Local restaurants were frequented. And the pandemic obviously shut that down because the larger companies were able to pivot and change and create degrees of freedom in their business model that a small boutique or a small restaurant just wasn't able to do. Now that we're coming out of the pandemic, we saw a surge to those small businesses again for a couple of reasons. One, we know consumers want that sense of community, and that's obviously tied to local businesses. And then secondly, the economy overall realized that that sector of the economy was just devastated by COVID. So there's a little bit of rebuilding that needs to happen, and communities, governments, and consumers in particular have really adopted that.
Go ahead.
Well, what about the tech part of it? Because we saw the adoption of tech. I know specifically on the healthcare side, there were discussions about whether or not telehealth was here to stay as a dominant force. DocuSign we saw, dropped earlier today, I believe. So there's been a mixed picture when it comes to who won and who lost on the tech side. What do you see as the area where companies really need to focus when it comes to the tech integration, considering the fact that we're now with hybrid workforces?
Well, obviously, the change in behavior created enormous scale quickly. And companies really had a couple of problems that came out of that. One, their growth algorithm that investors use to figure out whether a company is successful or not really got thrown off. And so it was very difficult for investors to say this company is doing well or not well because so much of the demand was artificially driven. And then when you look at the way companies reacted to that, if company got stuck just servicing their current business model or trying to fix operational issues, they weren't able to plan for that second and third wave of business growth that we knew would come out of a return to something closer to normal. So you're really looking for businesses that operated like businesses and built business models, built capabilities that were more suited for a longer term business environment as opposed to a short term blip in demand.
And you also had, I think this is what you were getting at, but you had companies like maybe Peloton, Carvana, who got way ahead of themselves, saw that initial demand spike and just got, I guess, way ahead of themselves in terms of capital investment and created their own little bubble. Just wondering, have we seen this largely correct itself, or do you see another leg down for some of these companies?
Well, clearly the market is showing that there's a correction. If you think about the way businesses get built over time, they have to survive multiple business cycles. The surge associated with COVID gave a lot of those pandemic darlings the opportunity to get that initial bump, and they were able to do it. But when you think about some of the home gym equipment examples, how many times do you need to refresh that equipment? That needs to be factored into the long-term business model and ultimately the long-term valuation of these companies. Until management teams are able to do that and create a longer term narrative story, it's very difficult for them to give the investor community confidence in that algorithm and the stability of their performance over time.
I wonder about all of this in context of the jobs report and how things have been progressing over the last several months. We know that while there have been jobs added, we've heard about some really major layoffs in certain sectors. And to the point about right sizing, do you see maybe a shift in what the future of the labor market is and whether or not this adoption of a hybrid workforce changes who becomes a lead sector or what companies become stronger?
Well, part of the downturn is just companies are naturally at that stage of cycle. We haven't really experienced a massive tech layoff like we're experiencing this time. So just like every sector goes through the cycles, this just happens to be the turn for those growth companies in the tech sector to retrench a little bit. Now, the question we're looking at Kearney when it comes to labor to demand matching is the skill that you need available, or do companies need to take a more active role in developing that? Now, as you see the tech sector start to lay people off, that produces a lot of high quality tech talent that other companies can quickly pick up. And that sector gets absorbed fairly quickly. But some of the other sectors may not be as quick to respond and to recover.
And we did see a drop in information technology of about 25,000 jobs on this morning's report. Really appreciate you being here today. Kearney lead partner Greg Portell and Yahoo Finance's Anjali Khemlani. Thank you. Coming up, the Academy Awards just 2 days away, but see what else is in store for the movie industry in 2023. Up next.
The 2023 Oscars is looking a bit different this year as streaming giants come up short and the focus shifts once again to traditional Hollywood studios. Here's how we got here and why the decline in streaming nominations might not be as dire as it looks. Streamers garnered about half the amount of nominations in 2023 compared to 2022, with the big three, Netflix, Apple, and Amazon, receiving just 19 nods in total versus last year's 37. Netflix was the most nominated of the bunch with 16 total nods, followed by Apple with 2 and Amazon with just 1. Keep in mind, Apple actually walked away with Best Picture in 2022 thanks to Coda. At the time, the win was categorized as a huge breakthrough moment for streamers, and it seems like finally the lines between traditional film studios and streaming exclusives had been blurred. But it seems like the Academy isn't giving in that easily. In fact, streamers were completely shut out of popular categories this year like Best Director. Remember, Jane Campion won in 2022 for Netflix's Power of the Dog. Not only that, but the number of nominations has been on a steady downward trend in recent years. Still, there's one big question to ask. Does this all matter? Oscar viewership has struggled, especially as the top moments usually end up on Twitter or YouTube relatively quickly. According to Nielsen, 2022's Academy Awards drew in 16.6 million viewers. That was actually up 58% from 2021's record low of 10.5 million, but still the second worst viewership number in the show's 94-year history. And let's take a movie like Knives Out, Glass Onion, for example. Only one Oscar nomination for Best Adapted Screenplay, but still the fourth most watched Netflix original of all time, with nearly 280 million hours viewed in its first 28 days on the platform. That's a pretty strong showing for a film not rolling in nominations.
This is truly delightful.
Or what about Top Gun Maverick, Avatar: The Way of Water, two of the highest grossing films in 2022, and yet nominated just 2 and 4 times respectively?
Just want to manage expectations.
You see, before streaming, there were obvious boosts in box office receipts after a film was nominated or won an Oscar. But with all the changes in media, it's hard to really judge the quote-unquote payout of an Oscar win, especially for streamers, which care most about subscribers. So even though streaming platforms may not be enjoying the same level of Oscar attention as they received in the past, it doesn't mean they don't have just as much, if not more, visibility, with hundreds of millions of paying users at their fingertips. That being said, the Oscars is the biggest award show stage of them all, with many industry watchers adamant that Academy Award wins and nominations do still matter. It just might not matter as much to the streamers, which are way more focused on subscribers and profitability than Oscar statuettes.
And with the 2023 Academy Awards just around the corner, we're pulling into focus the future of the movie theater scene and what's at play for the box office in the year ahead. Here to reel in all the details is Chad Bynan, Macquarie's senior gaming, lodging, and theaters analyst, along with Yahoo Finance's Alexandra Canal. Thank you for being here today, Chad. Let me just ask you, what are your expectations for Sunday?
Sure. Thanks, Jared. Thanks, Allie. Expectations. Well, obviously, as you just talked about, I think, viewership has increased. There's a good mix in terms of the big blockbusters and then also kind of the specialty art house types of movies. So my expectation is after March Madness, Election Sunday at 6 o'clock, I think there's going to be a lot of people that kind of stay over, continue to watch TV into the 8 o'clock Oscars, and obviously a red carpet show prior to that. In terms of winners, I'm not going to state my picks there. I have been able to see a lot of these movies, and I think we are seeing people continuing to go back to the theater, and that was evidenced in the January and February results.
And Chad, let's pick up on that. You say people are going back to the theater, but you did trim your forecast for 2023 box office revenues by 10% to $8.4 billion. What was the biggest driver in that decision? And when do you think the box office can reach those pre-pandemic levels again, if at all?
Sure. Yeah, I'd say in terms of blockbuster quantity, we're going to be back to about 85% of pre-pandemic in 2023. A lot of that is more weighted to the second, third, and fourth quarter, but it's nice to see that the amount of product has kind of recovered here. 2022 is back to about 65%. So we have a nice year-over-year increase. Really, our move in terms of estimates has really been on kind of the specialty art house, non-blockbuster movies. We're just not seeing the results, as you kind of mentioned at the outset, with some of these movies that really receive good ratings, but just aren't getting the same footfall and admission revenue as we had seen in prior years. So we took a little bit more of a conservative view on those non-blockbusters, which usually account for about 40% of total box office for the year.
Variable pricing has been a big conversation on both Wall Street and Main Street. We actually spoke to IMAX CEO Rich Gelfond earlier this week. He said he's not a fan. What do you think? Do you think this could add incremental revenue for theaters, or is it too risky of a bet given the macro environment right now?
Yeah, it's a good question. It is tricky because you're essentially penalizing the people that are kind of keeping the business intact. These are the core moviegoers who kind of show up, 6 to 12 times per year to see some of the great product that's out there. So to penalize them just in a higher inflationary market, at times doesn't seem great. There's certainly markets and times where they're able to increase pricing. A lot of the improvement versus 2019 has come through pricing. Some of the companies have the subscription model or a discounted model where you do get a set number of movie attendance opportunities in a month or a year, and you can go in at a 10 to 20% discount. I'm not a huge fan of the dynamic pricing, obviously, with everything that's going on with the consumer. What we have seen in prior recessionary cycles is this industry holds up. But this is a tricky one. If you continue to raise pricing, that kind of could force some people to decide to sit on their couch instead of coming out to see some of these movies in the big screen.
And I want to ask you about AMC and how you're seeing all of this play out with the company. You recommend the stock with an underperform, $7.61 price target, and a critical meeting this Tuesday. Shareholders are going to vote in a special meeting on whether or not to increase the amount of authorized shares and also do a 10-to-1 reverse split. Anything there that you think might be eye-catching or significant?
Sure. Thanks, Jared. Well, first off, we really like where IMAX is positioned here. We have a $22 price target. Our second favorite pick is Cinemark. We have a $15 price target. Stock has moved here over the past couple of weeks. In terms of AMC, look, they are continuing to do things that helps their cash flow position or cash position, as I should say. Raising equity would certainly be one of those items. In terms of the performance, we're kind of lukewarm in terms of what they can generate in 23, 24. Ali, you asked if the industry will get back to pre-pandemic levels. In our model, we don't have that happening. In 2024, I think we have it getting back to about still a 10 or 15% decline versus pre-pandemic levels. So for a company like AMC with higher inflationary labor and utility costs, higher rents, and overall lower margin, it's just hard for us to justify anything other than our current rating. In terms of the upcoming meeting, we want them to win. We want every company in the space to survive, to thrive, to continue to offer this to consumers nationwide and worldwide. So we're hoping that this does work out, but it's been a very difficult position just because of the debt and the lease obligations that they have on their balance sheet.
Chad, I'm pulling for them too. Hope they pull it out in the end. And thank you for all your insights here. Macquarie's Chad Bynan, along with Yahoo Finance's Ali Canal. Now, coming up, Walmart is narrowing the gap with Amazon in one key area. Find out what it is up next. Walmart closing the gap in its battle with Amazon to attract customers to its online subscription service by cashing in on higher income households. Joining us now is TD Cowen Senior Research Analyst Oliver Chen. Oliver, thank you for joining us here today. So let me get this straight. So we know that Walmart Plus has been kind of encroaching on Amazon in terms of e-commerce and their piece of the pie there. What is the latest, and how far have they made inroads into this?
Yeah, Jared, we are excited about the Walmart story. The bottom line is 90% of America is within 10 miles of a Walmart. So thousands of locations are very strategically competitive in terms of what's happening in retail. And the future of retail, in our view, is bricks plus clicks. So the Walmart thesis is playing out, and Walmart Plus is a very key competitive advantage in terms of Walmart having its own membership program to compete with Amazon Prime. What's really happened at Walmart is increased convenience, and that's happened with curbside pickup, buy online pickup in store, delivery, and shoppers this year are going back to stores too. Walmart is one of the US's biggest grocers as well, with over 55% of revenue being grocery at Walmart. And that's a very helpful topic too, in terms of frequency, scale, and the Walmart ecosystem. The other point on Walmart Plus is you get a gas discount, and everybody loves that.
Yes, and let me just get back to the groceries for a second, because Walmart Plus offers free delivery on orders more than $35. Amazon has raised that same threshold to $150. Just wondering if that's making a dent in the numbers yet.
Yeah, consumers right now are looking for value across the board. And Walmart has the advantage of scale and also extremely efficient operations in stores and curbside pickup, and really staffing that appropriately. On the longer term basis, Walmart is thinking about micro fulfillment centers, but you're 100% correct in terms of what customers are looking for. Inflation is a hot and important topic, taking money away from consumer dollars. So everybody's looking for value. And don't forget, zooming out, Walmart's focused on everyday low prices. That's a core competency for many, many years of the Walmart story.
And let me ask you how that jives with the demographic, stats that I'm looking at here. It looks like Walmart Plus very much skewed towards younger people. We have the 25 to 34, 35 to 44. Those are getting about 25% of the market share. Then you go up on the flip side, you have Amazon in the 65 plus group. They get 17.5%. That dwarfs what Walmart Plus is getting right now. So if these trends remain in place, what does this say about the future of these services for Amazon and Walmart?
Yeah, we're excited that Walmart has really embraced the younger customer and also the higher income customer through partnerships with American Express and others. Convenience is something all consumers value. So if you think about curbside pickup, very, very high customer satisfaction, net promoter scores, and time is a luxury. So Walmart enabling you to save time. So skewing with younger customers, attracting higher household income customers, those are all very strong positives for retail, and all of retail is really looking for this in different ways. So the future is bright. What's happening over time with Walmart Plus is the company is likely to add more convenience and more services. And Walmart in America plays a big role. I grew up in Natchitoches, Louisiana, and Walmart, the supercenter, was a big hub of the whole community. Mm-hmm. You know, I got vaccinated at the Walmart pharmacy. Thinking about Walmart and financial services, this is a much more holistic global view, and Walmart's DNA is stores. Having these stores and having that fixed expense base, leveraging that is very powerful for the long term.
And that's something stores is not in Amazon's DNA. Of course, they own Whole Foods, huge footprint there. But I read, I think it was 2 weeks ago, they're closing certain Amazon Go locations. Now, it's not like they had a huge network of these stores. That's where you can pop in and pick anything off the shelf you want and just exit without a cashier experience. But what does that say about Amazon's push into the brick and mortar?
Well, it's very tough to run stores. Also, what's happened with stocks and cost of capital is an important focus on profitability. That is Walmart's core competency in terms of retail and stores. And even running these very efficiently, it's not a high margin business. So lots of developments here in terms of the future, but the future is digital, moving more physical with a lot of the changes we're seeing. Also, grocery is a very fragmented industry, but we're looking at a lot of technology. We like what Walmart is doing with artificial intelligence and image recognition and inventory management. And what we look at in terms of Amazon is a work in progress with what's happening there. I don't cover the stock, but they're great points you're making.
All right. Got to leave it there. TD Cowen Senior Research Analyst Oliver Chen. Thank you. And let's do a final market check here. We've seen a mixed market most of the day, but now we are looking at all red arrows, but not big ones. We're seeing the Dow off 12 basis points, S&P 500 off about 1/3%, Nasdaq off 1/5%, but Russell 2000, that's where the losses are centered, down 1.5%. And just want to get a quick check on the banking sector here. We've seen SVB, that's SVB bank shares, frozen all day, and they are indeed frozen still. And we're seeing some fallout in other regional banks as well. FRC down 24%. And let's get a quick check of the bond market as well. We've seen the 10-year sliding about 20-30 basis points, 18 basis points today. Tack that on to yesterday's losses, and we're looking at the biggest slide since November. So that is all we have for now. I'm Jared Blickery. Check in with us later today. Thank you.